Morning, everybody. Afternoon, night, wherever you're at. Getting a few more things set up here. Some people load in. We'll get into what the markets are doing, look at some individual stocks, and then we'll stream the Jerome Powell live. Right. Hello, 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 everybody. Thanks for tuning in. We're going to be looking at, once again, some individual stocks, see some of these larger market cap names, see what's moving markets, and then ultimately get ready for Jerome Powell to hit the stage with his press conference. That's going to be in a couple of hours. I'll probably have that playing. I will have that playing live, and then I have just worker construction coming through here at about 11:30, I think it is. So I might have to step away for just a brief second while Jerome Powell's doing his press conference. Boots and pants and boots and pants and boots and pants and boots and pants. What's up, Mechanic Matt? Hey, Bambino. What's up, House of the Rising Funk? What's up, Red? This must be one of the reasons I don't have friends. It's pretty funny. All is well. All is well. Hope all is well with you too. Hope all is well. It's a slow start for the day. We haven't done much. So I'm going to just follow up on yesterday's chart that was in the market brief, kind of show you where we're at. So that larger exposure level that there was a lot of concentration at was at 683. And what have we been doing? We've basically been breaking from it, coming back in, breaking from it, coming back in, breaking from it, coming back in. So we're just kind of pinned in and around that 683. There's a couple breaks, right? We broke through this area and we tried to go to that 681. I was actually looking down here for a potential shorter term bounce play. We didn't quite get down there. Now price is holding 683. Let's take a look at market net flow. Not a really good look for market net flow, to be quite honest, right? You have the red line going up. You have the green line going down. Starting to get convergence to the downside. And SPY is, once again, just doodling in around. Okay. As far as gamma, gamma levels, 0 DTE levels, 1 DTE levels on the S&P 500 on my left-hand side, 6860 to the upside, 6810, 6800 to the downside. And up a little bit further, there was some concentration up at about 6,900, which was one of the levels we talked about yesterday. No shock there. From a net gamma perspective, that's, relatively bigger level there too. So what are we doing overall? This is the 2-minute time frame over here. And this little blue range is only just a 30-second range. So the first 30 seconds since the market opened up, the high, the low, and the midpoint, where are we? We're right outside of it, or we're just trading right outside the lower end. So when you're below it, you'd think that you can have continuation to the downside. Market net flow suggests that as well. But ultimately, what are we doing? We're kind of just pinning it around while we wait for the Fed. There are some big market movers today, which we'll take a look at some of those 2 standard deviation moves to get an idea if there's anything going on there. You've been super busy, Matt? Yeah, I get it. Yeah, healthcare. Healthcare was a great. So we talked about that one yesterday, and I think that, I went into healthcare yesterday. I sold a little bit today into the upper daily implied move, which what I typically do. So you look at healthcare, right? This is the daily time frame on the left-hand side. The weekly implied zone over here, we came into it. Now we're bouncing back through. We're still below a declining 5-day moving average, but I like to play these type of things where you get, some positive divergences or a little bit oversold in the RSI and you undercut the weekly implied move in a direct fashion, I like to play back into it. So far, that's paying out. So I took a little bit of the profits and see what happens kind of next. Okay. And we can pull up some various names there too in the healthcare sector if you guys would like. Alrighty then. So Jerome Powell's coming out, doing the Fed interest rate decision. We're going to get some projections. There's about a 90% probability that we're getting a 25 basis point cut. So that's what the market priced in. 25 basis point cut is coming. Anything outside of that, obviously, is outside of the market's expectations. We can cause even more volatility. And then anything that the Fed says, right, could be tilted hawkish, could be tilted dovish. I don't think it's going to be overly hawkish. I mean, that's, I feel like coming to the end of the term, I don't think he's going to want to shake up markets all too much. We'll see. I think that's not his main objective there. Lyft, LYFT, is getting pretty slammed today. Uber's making a pretty decent move too. So here's Lyft. I'm going to pull up Uber. You got Uber, both getting hit. And Uber is coming into its year-to-date volume-weighted average price right now. Okay, after a pretty strong move. Now, these are typically news catalysts, news-driven. Sold Uber Technologies over here. Joe Terranova. There was some news out. Okay. Sometimes these move acts as reflexive bounces. There was one that I traded yesterday, JPM. Right, I tried to trade in and around some of this move over here. Caught a little bit of a bounce on this trend break. I left some on this time around, and then I sold into its upper daily implied move. I don't have, well, actually, I take that back. I don't know if I have any more left. Let me take a look. No, I don't have any more JPM left. So it was just a quick bounce. Decent, right? So that's, if I look at this, by the way, just so you know, this move in JP Morgan, this right here, this range of a candle was its, I believe, third largest in history from basically high to low. Second or third. So it was in the top three. That's what I remember because I analyzed it. I don't have the chart in front of me though, but it was a big wide range. Now, from a percentage standpoint, that's not nearly the biggest day, right? But from just a point range, it was up there as far as history goes. Top three. So these type of moves, you can get reflexive bounces back, right? Think of a rubber band, right? You stretch out a rubber band, you stretch it. What happens? It snaps back, right? Just common stuff. So when I look at something like Uber, right, as it's coming in as strong and hard into this, yeah, there's chances are we'll probably see a bounce at some point, right? Oh, shocking surprise, right? When I take a look at Lyft, I got to pull Uber's expected move, but here's Lyft. It's outside of a 2 standard deviation move right now, right? Doesn't look like the greatest chart, but overall, right, what are we doing? We're just kind of ranging around. Could be distribution to break lower, absolutely. But even when you get strong moves to the downside, right, you can get some bounces. Strong moves to the downside, you can get some bounces. So if you're interested in various stocks, sometimes it's great to watch these larger, implied moves. I traded FTNT today, Fortinet. Right, this was the 2 standard deviation move today. What did I do? When it broke the trend, I bought some, I played it into daily VWAP, and basically I was out from that point. Just a quick move, right? So here's my risk. Here is my reward. Could have left some on. I didn't because we had the Fed meeting, so I just took it off pretty quickly. But if I look at the daily chart, right, is this something that I would want to hold? No. Doesn't look all that good on the daily chart, right? Yeah, we'll take a look at XLU. I don't have any exposure to XLU. They are really sensitive to rates. From a perspective of just price action, yeah, it looks like it's going to probably bounce here in the near future. So if you want to play for a little bit of a bounce, absolutely is a possibility here.
No on track for 20 million lifetime rides by year end.
Natural gas has been taking a little bit of a hit, and that's been in kind of an uptrend. So I remember notifying natural gas when I saw these higher lows over here, and then it kind of got off my radar on this undercut. I just wasn't a fan, and unfortunately, that was kind of this shakeout move before heading higher. Go figure. This is natural gas for you, but natural gas has been seeing these higher lows, right? And then we got pretty frothy up here, right? It was a pretty strong move. Now we're coming back in. Is this going to perform some sort of a higher low and we're going to bounce back up? I have a little position there, but it's not even in my main account. And I'll probably end up cutting a little bit today already. So I got a little bit of that yesterday. And once again, a little bit because natural gas is crazy. I'm not much of a fan of trading it, but when I see like strong moves in very fast fashion, I don't mind trying to trade with the prevailing trend and fading the shorter term move. So shorter term move down, prevailing trend is trying to move up higher. The shorter term, right over here. Silver breaking out to new highs. I don't know. If you were thinking about fading anything, this could be a potential opportunity as the Fed comes out. Who knows what the Fed's going to say, but if the Fed, right, if you go into like the trade tab and you look at the options market, I'm just talking like 0 DTE, sort of like low cost lotto type trade. I mean, these things are 3-4 cents. You buy it, you hold it. Well, most people actually, if they buy a 0 date, they get cut off at like the last 30 minutes of trade or something like that. So you might have to go out a little bit further, 2 days. But nonetheless, that would be kind of like a lotto look there as price actions here and then 54s right here. So if Fed comes out and it has a poor reaction, right, you get your rate cut, whatever they say, maybe the yields shoot up higher, puts pressure on something, or whatever the case is, right? 10-year yield backing off a little bit so far right now, which makes sense after a pretty strong move. We talked about that yesterday on yesterday's brief. We looked at oil, right? And we said, hey, well, oil has been coming off. Is that, giving us indication that we'll probably see a bounce in bonds? Today, that's playing out, right? A little bounce in bonds right at that year-to-date VWAP. Dollar down today. Dollar down today, which obviously helps various commodities. Silver's playing off on that. Gold is relatively flat. Probably getting consolidation here, but it's holding up well with that spike in the yields as of recent. So overall, though, I mean, this looks like a pretty nice consolidation, right? Pretty nice consolidation in gold. And price action is getting tightened. As we know, right, one of the basic principles of technical analysis is assets. They move between periods of expansion and contraction. This is contraction, so what comes next? Expansion. Whether that's to the upside or downside, I don't know, and I don't care. What I care about is being part of it if it expands to the upside and not being in it if it starts to break down, or not being long if it breaks down. So it gives you this smaller risk to reward, right? So if this was your risk range right here, and you're trying to play back to these highs, and if you're trying to play back to these highs, and this is your risk, that means that through here, right, this is what you're risking to potentially get a reward. What is that? That's about a 2 to 1. Sorry, 1 to 2 risk to reward. You're risking 1 unit, potentially getting 2. And that's just up to these prior highs. Who knows how high this thing could go? But you just gotta, find these type of setups. And if it breaks down, you gotta respect that. Because if you just let it go and it just starts snapping down, it's hard to make that kind of stuff up. Yeah, so I just talked about Uber and I just talked about Lyft. So Uber, once again, it's at its year-to-date volume weighted average price on a very strong 2-day down move. So yeah, you're probably going to see bounces in this. Okay, it's probably nearing that place of a bounce. Okay. There is news out on Uber. I didn't catch it. Somebody sold. Okay, whatever. Right. But if you were looking to play an intraday bounce, right? I mean, these times, I mean, around these times is totally fine. Let me see if, let me see here. Give me a second here.
Google in a blog, Gemini 3 to Stitch. It's experimental.
Okay, so we hit a 2 standard deviation weekly move. That's 84, 84.36. 84.36 is a 2 standard deviation move. Yeah. So this is what weekly expectations were for 2 standard deviation move. I want to make that like a darker pink. Okay, so that's weekly. And then daily was 85.57. Edit properties, 85.57. Okay. Edit properties, will make this one the lighter one just so I know that it's daily. Okay. So from here was yesterday's close to here. That's a 2 standard deviation move. It's about $3.50. Give me a second here. Okay, sorry. So really, so if I come down here and we go down a little bit more, 1.75, that's the expected move, I believe, here for Uber for the daily, or right around there. Let me pull it up. And we're trading roughly at about a 3 standard deviation move. So very similar to JP Morgan yesterday. It was a 3 standard deviation move. So yeah, way outside of market expectations. And remember, if you're like, well, what's that even mean, 3 standard deviation move? We'll pull up a distribution curve, right? We'll pull up a distribution curve and I'm going to show you what it looks like. Uber, all right, let me go live all range there. Yeah, 1.75 is the, okay, so 1.75. So this is, right here is a 3 standard deviation move.
Any in Italy,
daily.
it is to discuss
Basically right there, okay? So edit properties.
And present strategic plan.
Make this blue, so you know that this one is 3 standard deviations. Extend to the left, extend it to the right. All right, so yeah, this is a huge move, right? So typically, to get moves like this, you need earnings events, right? Or you need news catalysts and so forth. So then when you go into the daily time frame and you see this, you're like, holy heck, right? Yeah, 2 days in a row, bam, 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 bam. And it's hidden to year-to-date VWAP. So yeah, if you want to play for a bounce, just know that this chart, it doesn't look good, but when you get these large outsized moves to the downside, they can be followed very shortly by some sort of a consolidation, some sort of a bounce. Now, that doesn't mean throw all your eggs in this basket. And the reason why I say that is because you are fighting a prevailing downwards trend. And if momentum closes to the lows, you can get follow through. And if you're too big in size, what happens is you end up capitulating and worrying, and then all of a sudden, then it snaps back. So it's, you gotta in these type of cases, you need to approach it with a different mindset as you would approach it differently in other situations, right? Like if it was trending up higher and you're playing a breakout, right? Everything requires a different kind of approach. As of recently, as we broke down through this 3 standard deviation move, you do have quite a bit of volume, which, you know, we had quite a bit of volume right here on this down move, and then we kind of consolidated and went sideways. Now, if I pull up a distribution curve, I'm going to show you what exactly that means, right? If we're talking in terms of just probabilities. This is a distribution curve. Here is 1 standard deviation move. Here is 2 standard deviation move. And here is 3 standard deviation move. So 99.72% of the time, we finish within a 3 standard deviation move, right? 99% of the time, over that. So the probabilities that we go back above the 3 standard deviation move are high, right? They are high. That's just a probability-based trading. Now, is there room for it to close outside of 3 standard deviations? Yes. Unlikely, but still possible. Okay? So what do you do if you are a trader? Well, you look for price to confirm some type of move. Like, does that mean buy right now? It might in hindsight, but has it done anything? Has it showed us any sort of trend break or anything? No.
Medicare funding cuts.
So right now, what's it look like? It looks like from today's high to just if I were to trend down to here, it's tagging so multiple times. So this is a established downtrend. So the idea here would be, hey, if we get some sort of crazy kind of break from this trend line, maybe you start to fade into it. But ultimately, you want to see it break from it, and then that could potentially establish some sort of a low for the day, some sort of base building, and then go from there. That's how I would approach it. Right? Versus if you have no idea what's going on, you're trying to buy the dip here at 2 standard deviation move, and you're just buying it again, and then like what's going on here? Then you might say, okay, well, it broke the trend right here. Okay, yeah, but then right, it started breaking back down further. So are you getting out of it? Are you looking for it to reset up? Or are you just, are you averaging all the way through very, very slowly? Like if you're doing that, okay, fine. But it better be tiny positions, because this is where you could potentially get hurt, especially on a day where we don't know what's going to happen, right? So that's Uber, and Lyft is, pretty similar situation.
Just a bit further regarding these hospital names, does note Republican congressional leaders are considering a Medicare pay cut for hospitals.
Yeah, Pop Meow, who invests in a taxi company. A lot of funds invest in this company. You can actually look up the holdings of how many various funds hold it. I can tell you.
Republican House members in a meeting on Wednesday, according to a document viewed.
Yeah, and chances are, if you own one of these funds, you probably own and invest in Uber without even knowing it. It's funny because a lot of people, like some people say, I hate Tesla, it's a fraud. Yeah, okay, well, if you have any sort of investment in the S&P 500, you have money invested. You have money invested in Tesla, right? Yeah, all types of funds hold these names. But we're not talking about investing. We're talking about trading right now. It's a whole different ballgame, right? Like, I don't care really what it is. I want to make sure that it's liquid, it's setting up, and it makes sense from a probabilistic standpoint.
Some commentary from the Blackstone COO. Speaking at the Goldman Sachs conference, does states that needs in capital around chips and data center and power are so enormous, and they're really uniquely set up to go.
Yeah, I don't think you quite understand what Uber is. I get your passion, but your passion is misguided. Uber, dude, it's how to make money. It's all about time, right? If you can save people time, you can make one hell of a product. Uber is all about time. I can hop on this app and somebody will show up at my door to drive me somewhere in moments' notice. I can see it tracking in real time. If I want something like delivered to my house, I can use Uber Eats. Right? It's all about time. If you can save people time, and present situations like that, it's incredible. Or give people more time back. It's also incredible business. So, got to think of time is a huge commodity, and a lot of companies that are doing good are providing time back to their consumers in some sort of fashion. Even leisure companies, so they're not giving them time, but they're giving them relaxing time. Is that funny? No. Jerome Powell is going to be talking later today. He's going to be talking at 11:30 PST, 2:30 PST, or EST, sorry. S&P 500 still holding that 683. Market net flow still doesn't look all too hot going into this so far. And then we're just right there where we basically opened. Some might look at this and say, hey, it's kind of that inverse head and shoulders. And I say, yep, sure. Well, we're just basically pinned overall. Not a horrible look from a price action perspective. I'm looking at NQ over here. Not a horrible look at all. As we're kind of just, butting our head up at this, it looks like it can break through. But remember, we have the Fed. Don't have the greatest market net flow. If we can hold 683, what we talked about yesterday is it does set us up above 683, can take us to that more pull of a level, 685. Because that was an area of concentration on the aggregate, as well as today's price action, heading into today's price action. So you see how Uber's still kind of cracking here? So do you see why it could be important to wait? So we might be getting what we said, that kind of, break from this trend further. I'd like to see it on more volume. If we get some sort of a bigger flush, that can create a move right back up. So this I love, right? If I'm trying to fade something, I don't mind fading this type of stuff. I do prefer trend breaks, and I prefer larger kind of pushes to the downside for my executions. Yeah, convenience is kind of time, right? I mean, they kind of go hand in hand there. But then again, if you're busy and working on a project, like for example, if you're live streaming, you can't just get up and go get the food yourself, right? I can't go get it myself. I have to have somebody bring me food, or I have to shut off a stream. So it's, convenient, but also helps me navigate time better. Instead of walking away from something, I can stay here, protect my time, and have somebody deliver. So it all comes down to preference. It's all preference. But time is the ultimate commodity in our life. So if you can build businesses to make people's time smoother, easier, give them back time to do stuff that they prefer to do, there's businesses all within that. Very successful businesses. Requires some thought, though. Yeah. Wolf Banter. I usually have my butler bring me food. What's up, generator? Everyone needs a Jeeves. Y'all remember Ask Jeeves? Sounds like my training. Yeah, a little fridge. Yeah, for sure. Yeah, so far right now, Remy, it does stop at 2 standard deviation move, and then it's up to you to check it. But I am going to be talking with the developers, and I'm going to be working on doing some updates here that I need help on, and that was one of them. People do build businesses that steal people's time. That is something that happens. I mean, but it's still around time, right? Think of Meta with Instagram, the algorithms that just suck you in, right? Know how to keep you scrolling, keep you looking. That does take your time. And are they profitable businesses? Are they making money? Are they huge companies? Yep. Time and attention. Businesses are built off of time and attention a lot of the times. I'm telling you. Pretty crazy when you start thinking it like that. And you can control where you focus your time and attention. I'm not buying SPY at 683. No, I'm not doing this right now. I'm not playing this game. Not chopping around within here. It's been there all day. I'm looking at market net flow, and it's just not the greatest look right now. If I'm going to be trading intraday, it's probably going to become either off of just a sudden shock move, or I'm going to wait for the Fed to talk. Another name that broke to 2 standard deviations today was VG. I don't really know what that is. Venture Global. Not interested. Lyft. Yeah, we already talked about Lyft. That broke down, right? That's probably 3 standard deviation moves or so. This one, right? Following the same kind of path as Uber. Uber, yeah, Uber already talked about. What else did we see as far as big moves go? To the downside, yeah. Rig is oil. This one came into 2 standard deviation moves. This one's already bounced 417. Right, 417 was right here. This was a 2 standard deviation move in rig. That kind of just bounced right from it. FTNT, we already talked about that one. This one was a 2 standard deviation move. It kind of bounced right from it. So a bigger one right now is Uber and Lyft, and that's just trending lower on this trend line. So if you've been buying this down, right, you're probably stressing. Right, you're probably stressing. Now remember, this right here is that 3 standard deviation move. 99% of the time, plus we finish back within that. So we're already in very rare territory, very rare, much more rare territory, meaning that the market priced in a move. It got shocked. It's way outside of expectations. And then if you look at just the true range of this candle, you date over here, like this is a very, very large range. And you can see, well, it's actually happened over here. All right, that was a big move. Ended up going lower, but then bouncing. So. Meta hit the lower weekly. Yeah, let's take a look at some of those. Let's take a look at some of the larger cap stocks and where they stand now. I'll pull up my handy dandy. Side by side, we'll start with Nvidia. Okay, if you see right here on the left, this is the daily time frame. This is the expected move. Nvidia is currently under its inclining 5-day moving average and still just kind of testing its little volume weighted average price right here from this kind of big reversal candle. Okay, so Nvidia, we have Apple, no tag of either yet, but still below a declining 5-day moving average. We got Microsoft, pretty much unchanged on the week. Choppy sideways, below 5-day moving average. It's neutral, but starting to trend down if we hold down there. There's been yet no tag. This one came off the back of news, obviously. This was looking good yesterday, and then we opened up with a gap down, which negates the good-looking price action. So you need price to now prove itself. Somebody had mentioned Meta, right? Meta's outside of its weekly implied move. So this one yesterday, we talked about how if it could come within this range, this could be a potential area to buy this pullback, right? As it's above this VWAP up here. From a daily perspective, let me see here if I look up Meta. It did come into its lower daily implied move, but that was pre-market. So I would prefer to see this actually more down in this range, maybe even below this, to even consider the execution, or at least a start of it. We got Amazon. Amazon just butted its head on its high VWAP over here. Now we're kind of breaking through this. So if you're long Amazon, ideal stop would be down here and you're pulling it back up into this area. It's above its 5-day moving average. Its 5-day moving average is currently declining right now, but price action's above it. So it's giving you just kind of caution. So if we can hold above this area, this will start to turn back around and that'd be more positive. Tesla. Just consolidating, going sideways. Zero. This is just, I just built this. I saw another trader, Brian Shannon, have it, and I thought that was cool because I use the 5-day moving average too, the direction of it. And then he just built out the visual, and I was like, I like that, so I just built it out myself because he didn't share it, or he shared it like with his subscribers or whatever, or at least I think he did. But I just built it myself. It's very simple. I have the script in the Discord. If you're in the Discord, you can go to scripts, the scripts channel, and it's in there for Thinkorswim, right? I have it for Thinkorswim, and then I have it for TradingView. Another one, obviously a big name, was AVGO. I'll pull up that. And this one's been strong. Strong like bull. No tag yet of its weekly implied move. Just putting in higher lows right there on the 30-minute. All right. The pin continues. Why MA65 for that? So it's because I'm on the 30-minute time frame. So 1950 is how many minutes are in 5 trading sessions. So whatever time frame that you choose, right? Say if it's 30 minutes, if you divide this by 30, it's going to equal 65, which is the average that I'm using. All right, if you take 1950 and you divide it into a 15-minute time frame, you're going to get 130. So this is the moving average that you would use on the 15-minute time frame to synthesize the average of 5 days. So whatever time frame you choose, you would say 1950 divided by the time frame of choice equals the moving average you use for a synthetic 5-day moving average. I'm doing it with a mouse. But still, and I'm left-handed, and I'm using a mouse with my right hand. But I still have bad handwriting. I got that left-handed chicken scratch. Yeah, healthcare is doing quite well today. Yep, it's moving. I can't say that I'm shocked. This was one that we talked about yesterday. We gave reasons as to what we can potentially see here in the near term with healthcare, right? It's been selling off pretty straight. It was outside of its weekly implied move coming into it, outside of its monthly implied move. So we're seeing a bounce back. And it's been in an uptrend. So these are opportunities that you can take advantage of. While people are freaking out, it's the end of the world here for healthcare, right? If you know and understand probabilities, it makes sense. And then when we looked at XLK, right, while XLK was going up, right, 12 days in a row, which is a historic record, close to it, right? 13 is the all-time like rank, 13 days up in a row. We're at 12, which is tied for second. Yeah, we saw this move up higher while healthcare was kind of going straight down. So we thought, hey, if we can get a little rotation or consolidation out of technology, perhaps that means that we're rotating back into healthcare. Right, and healthcare is the top performing sector on the day right now. Right? Things can change in a moment's notice as soon as the Fed comes out. So for me, right, I traded healthcare and I sold some of it. I bought some yesterday, understanding this, sold a little bit into the move higher. That's it. That's all I do. I'll keep some on just in case. And with these type of names like XLV, like this ETF, right? I understand the beta of this product quite well, right? So I'm okay with going a heavier size, you know, going bigger and then trimming. So I'll pull up some of those names. Yeah. So utilities. Yeah. So same thing. You'll probably end up getting a bounce here soon in utilities. We'll see. Once again, I didn't trade utilities only because of the Fed interest rate decision, and these can be rate sensitive, which could be good. It could be bad, right? But yeah, we're kind of nearing that spot where we can potentially start to see a little bit of relief in utilities. Healthcare had the stronger outperformance, so I was more interested in healthcare. Yeah, maybe Andrew. I don't know. You know, those are narratives, but the thing is, I can't really trade based off of a potential narrative because I can be wrong for a very long time for something to play out. And I need my goal when I swing trade, it's to make the most amount of money in the shortest amount of time with the least amount of risk. So, and then focusing those three things on the things that I can control, which is how much I buy it, when I sell it. Sorry, I got confused there. So 4 things: what to buy, what to buy, when to buy, how much to buy, and when to sell it. Getting confused here. Those are the 4 things that I control. I can't really control where price goes, or narratives and how they play out. Now, narratives, right, to an extent help because you can think as long as you can think in terms of a catalyst and you can plan for a catalyst, that there's potential in that. But the bigger narratives, right, sometimes macro views and this can happen. It's like, yeah, you can be right, but it might take a very long time and you might miss incredible amount of opportunities waiting for something to happen. And it might never, ever come, right? So yeah, a wicked potential of finding stocks, right, that are setting up from a technical perspective that potentially have catalyst or news-driven events that can move. Yeah, that all makes sense. It can help direct you into what to do, where to go, and so forth. But like, let's say if you're right with healthcare, okay, so that doesn't mean I can't make money on a little bounce, and you could still be right. I can tell you one thing: I'm not going to hold it down to 130, or if it crashes, that's not going to be the case. Not going to happen. I'd be out. Out quick. All right, let's go check in on our friend Uber. And then somebody had mentioned, some UNG and stuff like that. We'll pull that out. So we're like kind of near the potential of this little break here. Doesn't mean it's going to go V-shape recovery by any means, but it's still kind of just holding lows, dragging lower. And, you know, the lower we go on this extended move creates those opportunities, and you play it back in to and around, you know, up these levels. The 3 standard deviation move. What was this purple line? Was this a weekly 2 standard deviation move? I don't know why I made it purple. I thought I made it darker pink. Now it confused me, but whatever. Nonetheless, we're kind of below those levels. Can you say it? PayPal. I think there's opportunities in things like PayPal, but yeah, it just overall, I mean, I don't know, right? It just doesn't look like a good chart. So if is it like from an investment perspective, I mean, it doesn't look good from a charting perspective or from a technical perspective or anything like that. But, you know, maybe it gets out of its own way eventually here. I'm sure that there's opportunities within, a big name like this. So yeah, I think that there's those possibilities, but you're still fighting the trend. So are there going to be better opportunities to buy it? Probably, but that might come at the cost of a higher cost. Oh yeah, Rascals. Thanks. Yeah, thanks for reminding me. Yeah. So I already talked about and this natural gas. I talked about how I got into it yesterday, just a little bit because it's so volatile, but I don't mind fading the shorter term, stronger moves when we're kind of trying to do an adjustment to the upside. So I have, like I said, a little position here. I'm looking at it right here on my screen. And what I discussed was I don't like trading natural gas. I don't. It's too volatile. It's all over the place. If you can catch like shifts in trend, you might be able to hold on to it. But the only way you hold on to natural gas is if you have your positioning on lock, because it's crazy, right? In 3 days, we went from 17 down to 14, right? That's minus 20%. I mean, we can be right back up here. That's 10%, right? It's absolutely insane. And you have these big gaps. It's everywhere. So from a technical basis, I'm not much of like, hey, it's consolidating and flagging, but I might pay attention to, higher lows, lower highs, and so forth. And then when we get pretty fast moves in a counter trend to what we've been doing, yeah, I don't mind fading that. So I took a little bit of a position in that. Like when I say little, it's not big. And like I said, I'll probably cut that. In fact, I'll probably just cut it right now while we're talking, so I don't forget about it. All right, we're now trying to break through the upper 30-second opening range, but ultimately, what are we doing? We're just trading around. Let's take a look at market net flow. Still doesn't look all that great, but we did lose convergence. So convergence, losing it with a bearish divergence can be bullish, right? It counter trends moves sometimes there. But overall, we're just kind of floppy jalopy. You can see 683 still holding when we get through 683.
October copper production at Codelco.
We had 685 as a potential target.
Down 14.3% year over year.
So that would be the upside. I don't know if we can get there before Fed, after Fed, or what, but that's kind of where we're at now. Rocket looked like it was going to rocket. I have a position in Rocket too. What did it end up doing? Yeah. Reversed on itself. So I ended up selling a little bit. I don't know when, but let me see. I didn't sell much. I sold 25% on today's move higher into and around this. Actually, yeah, it was right in and around here as we came into the upper daily implied move. But still, it's holding up right now. I like the flag. All right, so we broke out and then it's just sitting squatting back in, whatever. Take a little bit. Now, if I comes down here, breaks down, closes under it, I'll get out for a little loss, I guess. Final month of the year, people. Final month of the year. How's your portfolios doing? Today, I hit a new all-time high in all of my accounts. And I'm not just saying that. It gets verified by a third party every month.
Update from the ECB. McLoof says confident medium-term inflation will
United States Investing
at 2%.
I don't compete in. Well, I guess technically I am competing in it because I'm in there, but I don't actually try to risk the biscuits, so to speak, to actually come in first. Not with this portfolio. Can't take that type of heat, that type of risk. So you'll probably never see me have an 800% gain year on this portfolio. But maybe if I do the minimum, maybe I'll try to push limits and see how much it can go. But it's just not my style. I focus in on like 2% a month, which is great. Nice, Jims. What if I don't want to verify because I trust you? Well, You can always, if the trust fades, you can always verify, I guess. I think it's important for people to, especially if you have audiences, to just verify your trades. I mean, you don't need it by a third party, right? At least to verify, you at least know what you're talking about, or at least you're playing your own book, like, right? So I'm all about managing risk and setting pretty clean expectations of what I try to do. And I talk from that perspective. So I'm not coming back and saying, I made 700%, but yet I'm talking about like managing risk, right? And going slow. So there's alignment there that can be verified, which is important. All right. Because I've seen people like talk a big game. Like, so it's funny because I used to make fun of Meet Kevin about this. And I think maybe he's changed quite a bit since this, but he was talking about like, he'd always say the right things and he'd always have great narratives and all this stuff. But then I'd see his portfolio and I was like, dude, what do you, like, you're doing exactly the opposite of what you say to do. Like just massive positions in like single stocks, taking massive hits, not managing the risk, So my point is,
copper again, Chilean mine Escondida copper production.
If you talk a lot,
11.7% in October.
You at least have to
120,600 tons.
Show that you do what you say, and then show that kind of methodology works. If that makes sense. That was a long time ago. That was like more towards like coming out of COVID or something like that. I remember just like seeing some of it. It was like Disney. It was like just an insane position, and also Tesla, as they were just getting just hammered. But then it changes. The talk track doesn't match what you're actually doing, and that's the thing. A lot of traders do this, by the way. A lot of traders are like this. They'll have their strategy. They'll have an idea of what they want to do, but then they don't do it. They just succumb to
the Collahuasi
their inability to have discipline.
29.3% year-over-year in October, 235,000
Everybody does.
Tons.
Right, but once you get to this point where you're like, you can't have that happen, things change. Like, I can't blow this portfolio up. I can't do that. Not going to happen. I'm not going to put myself in a position to blow my portfolio up. Will not happen. Will not happen. Cannot happen. I don't do that. There'd have to be, like, I don't even know what would have to take place for this portfolio to blow up. Like, the dollar would have to be worth nothing, I guess. Where this I can't spend this money. It's what would happen? I don't put risk out like that to blow up an entire account. So I don't know. I haven't, Shafe. Yeah, maybe, Remy. You never know. Yeah, I definitely don't use the martingale strategy. Will not blow my port. Do I think Bull can test $12? Maybe. Let's see. What's up with Bull? Just a wonderful looking chart over here. Just kidding, being sarcastic. I mean, yeah, sure, it's possible. Of course it's possible. We were there not too long ago. Yeah, it's possible. It's possible, it's probable, but where are you going to manage risk? Where would you be willing to say I'm wrong? Down here? So if you go right here, right now, and you say, I'm wrong under here, or maybe a close under there, right? It's basically a one-to-one risk to reward. Are there better one-to-one risk to rewards out there right now? Yeah, there are. I mean, maybe you're like, no, I'm gonna have my stop tighter. Okay, fine, then have your stop tighter. Just because it's possible doesn't mean that, like, what if it does this? You're like, yay, I was right. It got to 12, but it did this to get there. It just skews your entire risk to reward. And if you do this over time, your strategy is going to fail. So yeah, it's possible. But where's the risk parameters? Say if you're like, I'm going to go long, I think it's going to go to 12, and I think it's going to break out, and I'm just going to have a stop right here at this low. Okay, well, get out, and if it comes back up, you can always try to reset your positioning. Take a look back here at the markets. SPY just doodling around its 5-day moving average. Market net flow, bearish divergence, but no convergence. There's a pull at 682, which is slightly below us, but yet we're holding above that 683 green bar. In Q, we are trading exactly where we opened today. Saw a nice little move to the upside. Now it's kind of just pulling in here, consolidating. And about an hour out before we get our Fed interest rate decision. It's coming up. Is Uber bouncing? Yeah, let's take a look back at Uber. Yeah, there you go. Okay, well, cool. So hopefully you guys were watching this little trend. Doesn't mean it's over and done with, but there you go, right? So, oh gosh. Cool. All right. So yeah, a little bit of a bounce. I mean, it's nothing in the grand scheme of things here, but okay, we were following this trend lower. We started breaking from it right here. So, you know, if you play right here, this would be the risk. And if you just get to this line, which is a 3 standard deviation move, that is about a 1 to 1.5 reward to risk. If it goes up higher, I mean, just look at that. That's crazy. So you can mitigate some of the risk by taking partial profits on your first initial move, your bounce, right? And then you could let it go and just say, I'm going to hold it for the remainder of the day, maybe even into tomorrow. It just depends on how you structure it. For me, you know, I like to trade some size when I day trade. Like it's not, I would never hold a day trade position overnight because my sizing is significantly different. But I wouldn't mind cutting it fully on a nice gain and then holding it for a regular swing trading position, if that makes sense. All right. Tesla? Yeah, we can look at Tesla, but in order to look at Tesla, we need to hop in to the Tesla car. So let me hop into my vehicle. Let me hop into the Cybertruck. Make sure my lights are on. Oh, wait. Oh, they were on, so let me turn them back on. I can turn them off and on. Turn my headlights on. So Tesla is coiling up right now. The whole market's coiling up. You are seeing some higher lows. Price action getting very, very tight for a potential move here in the very near future with Tesla. And overall, we've been going sideways for quite some time. We're just consolidating here, and you can see this is an inside trading candle here, just coiling up. Coiling up. I guess I can stay in my Cybertruck if we look at Uber too, because, you know, maybe I'm coming to pick you up for a ride in a Cybertruck. Your ride is here. Hello. Hello. All right, so there you go. There was a 1-to-1 risk to reward fading the current move of the day. Right? Well, it didn't quite get there yet, but we're right there. So throughout today, what did we say about Uber? We said, yeah, if you keep on trying to buy it, right? You better start small and then try to average it lower if that's the case. If you think that we're going to come back within the 3 standard deviation move, or you wait for confirmation, wait for a trend break, then see what it looks like at that point. This right here would be like a 1-for-1. And then from that point, you either reduce your risk and or update your stops, and or you might be targeting higher. But just don't let it go like this and come break down severely, right? Manage it. Manage it. All right. Talk on the phone. drinking my LaCroix. I'm on the phone. Hey, what's up? Yeah, no, I'm just on a little cruise. Yep. I'm coming back. All right. Healthcare now up 81 basis points on the trading session. Monthly implied move is still above us there. Can't remember if that was a 2 standard deviation monthly move or just a 1 standard deviation. I think it was 1 standard deviation. They're at 151. BTU. What's BTU? Peabody. I mean, this don't look bad. Got this huge move up here. Look at all this volume on the way up. And then you're seeing pockets. See these green pockets of volume? Like these little spikes of volume. I love that. But overall, what's we doing? We're consolidating and volume's drying up as price action's just been going sideways. So yeah, I mean, this looks pretty legit. It looks good. Now, just because it looks good, you know, I would have to say, okay, what would it look like if it looked bad? Well, basically breaking under this would look bad. What would look really good if we start breaking above through here, this 30, and then we take off and try to retest these highs? Then you're talking really good risk to reward. Right? So it's kind of just on that fringe right here. Wouldn't mind seeing it consolidate a little bit more, but, you know, overall, you know, we're just consolidating. We're coiling up, getting ready. Contraction leads to expansion. I want to play with it if we expand. I want volatility to expand in my direction, not against me. And by the way, I always try to find things from a long perspective, right? If it looks bad and it looks like it can break down, you know, I'm not necessarily trying to like look for massive short positions or anything like that. It's just not my style. Not me cup of tea. Got AMD. Let me clear this drawing set out. Yeah, AMD has to prove itself here. This was a pretty big break here, and now it's kind of just
from the New York Fed.
flagging. So yeah, I would need to see it back above these, you know, like the 50-day to come up here. But right now, it looks like it does have that look and feel that, hey, you know, one wrong word can
Apologies
just
for the
snap this right back
interruption.
down
So
very
operation
quickly
on a New
as
York
volatility
Fed reverse
expands.
repo, that's 5.05 billion, up from the prior 3.2 billion, and that's across 17 counterparties, up from yesterday's 10.
So a very precarious little position there for AMD. Buyers need to step in, and they need to step in rather quickly here. And then again, I mean, look at semiconductors. Semiconductors have been straight up. New highs, right? New closing highs, all-time highs. Like these trends, they don't last. These trends break at some point or another. Get a little vol shock, so you look for pullbacks. It would still be within a bull market, right, at that point, but NVIDIA, it's kind of a similar look, right? It did look a lot better the prior trading session, but it's taken a little bit of a back seat here. So, and we had good news come out on NVIDIA, right? Hey, you know, we're going to allow China to sell our chips again. And then China came out and was basically like, nah, we're good. So it doesn't have the greatest look in the short term, but overall, you know, we've been kind of going sideways here. And then the longer term, obviously, it's been a rocket ship. So when I look at things like NVIDIA and AMD, and then I look over at the semiconductors, and you look at their holdings, right? You analyze their holdings. Well, I can't pull them up here, apparently. But you analyze their holdings, it's like, okay, if NVIDIA breaks down and AMD, I mean, these are some substantial names, that alone could bring down more semiconductors. For example, might have to look into Broadcom. Very bullish. Pullbacks, bam, right? It looks incredibly bullish. But if this starts to come off, yeah, you're going to get hurt in semiconductors. SMH is going to come for a consolidation, pullback of some sort. But new highs aren't bearish. New all-time highs are bullish. Okay. I'm not in Frog. I actually forgot to take Frog, but that was one of the names that I was looking at. Unfortunately, I missed it, but that's fine. Yeah. So Frog, I mean, in things like this, you would just update your stop to the low of the day of whatever, day you feel, most comfortable with. So originally it was going to be a stop under this, play the breakout. We saw a nice breakout, right? So you can update your stop to maybe the low of this day, or if today closes up higher, you can maybe update the stop to the low of this trading session and kind of just trail it in. And maybe it's not a full stop. Maybe it's just like a 50% stop, right? So think through, like, do you really want to get out of your whole position on a move like this? Or you want to just maybe lock in some profits, right? So yeah, we're getting a kind of froth from the 5-day moving average, right? We're trading sideways. Maybe perhaps you do a little bit of a stop here. It comes back in. Maybe you even look to re-add that in, on a consolidation. But it doesn't need to be like all one and done. You could think in terms of just taking partial profits or partial stops and trying to catch like a maybe bigger move. NQ just trading within its opening range here. Give me a second. I got to look at something. 11:20. Damn, this fool going to come at 11:20, right when the Fed's going to start talking. Shoot. We're bullish in 2021, 2022. So I go look at the videos. I have it all documented. Towards the end of 2021, I was actually getting pretty critical of markets. And I used a lot of sector analysis because energy was one of the top performers. And that made me believe that we can be seeing like a cycle top. So when energy starts to outperform the S&P 500, which it did these last 2 days, but leading into 2022, towards the end of 2021, energy was outperforming the S&P 500 pretty substantially for like a month or two. And when you have that happen, that can lead to early indications that we're near a market top. That's why I didn't lose any money in 2022. I'll show you the sector analysis chart that I'm talking about. I think I have it. This. So what we started seeing was energy outperforming. And if you have energy as an outperformer, it could mark
from White House Economic Advisor
a top of market. And remember, cycles, right? There's larger cycles.
Fox News.
There's smaller cycles within those cycles. And then there's even smaller cycles within those cycles, right? But with 2021 being so just explosive of a year and then starting to see this perform,
some more.
That was a pretty big warning sign. But not only that, if you remember looking at the price of oil back then, that's in and of itself like this was crazy, right? Oil was moving up pretty substantially. And when you see these large moves in a very short period of time, these massive rate of changes in the price of oil, bad things have proceeded shortly thereafter, or even collapses in oil, right? Dating back to like the oil embargo. And I remember sharing those charts back then. I remember pulling it up and using a 12-month rate of change in the price of oil and marking out the times where we hit 100% rate of change and what happened after. And that chart was quite popular, so much so that even these larger newsletter services just recreated it as their own. Equity clock.
And more from Hassett says,
You know, all those
stronger
seasonal
data could
charts by
support
equity clock?
50 basis point cut.
Oil's seen a little bit of a bounce here too, by the way. It's flat on the day, but intraday bounce. Let's take a look at VVIX. This is the volatility of volatility. There was some interesting action taking place on the options chain in VIX, you know, basically trading VIX futures. Some early positioning that probably led to this early morning sell-off. So a pretty big pop in volatility of volatility. Kind of makes sense to me as we're moving into a Fed event. So think of this as maybe in terms of like reaching for hedging protection, right?
Update for auto names and Ford. Ford suppliers received China's
Volatility
new rare
overall,
earth
not
licenses.
too
says
shabby.
Ford.
Nothing crazy. VIX futures down slightly.
Hassett further says you could definitely get to 250 or even more.
Now we have NQ coming in a little bit here. I am hungry. My stomach is just growling right now. I might need to take a break before the Fed meeting. I'm watching ticks. The lows of the day were pretty much around this like minus 400 to minus 500 range. I prefer them down here to be a more capitulatory type moves for shorter term bounces. Pick up a few points here and there from the futures market. If I look at everything, what would be my direction that I pick, bearish or bullish? I mean, I trade from the bullish side, so I always lean bullish. As far as like a bet as to where it goes, like I hope that it goes bullish. Like that's my direction all the time is I hope it goes bullish. But the thing is, if I'm wrong, your competitive advantage in trading is the ability to change and adapt. That's the number one competitive advantage. So even if I'm like, yeah, it's if I look at everything right now and it should be long,
says a 25 basis point
that confidence in going long
right direction
goes away immediately if price goes against it. Right? And just because I have all these technicals and everything in my favor, right? It doesn't mean that I'm saying, oh, I'm right and the market's wrong. That's just never going to be the case with me. It just can't be. I don't want to fail. All right, so we're breaking down here a little bit. We're getting more volatility. And tick chart's not really picking up on this at all. So it's coming from probably a couple tech names here. Microsoft's getting hit. Outside of its 2 standard deviation move, this is what's kind of putting the drag on the market. This does create trading opportunities, by the way, people. So I'm going to keep an eye on tick here. Man, I just wish it was more capitulatory across the market. Not the case. So to me, that's kind of nothing. It's a name or two bringing this down. SPY right back to 683.
Around half an hour to the rate decision from the Fed. We have reposted our Fed preview to the top of the headline feed. If you'd like to give it a read, we will.
So we pull right back into where
rundown 10 minutes before the announcement.
Area's been, so whatever.
And more from Hassett. It says President will make Fed chair choice in a week or two.
Market net flow still bearish. Still bearish. Market net flow coming right back into its upper gamma range. Once again, those type of moves, they do create fading bounces, but I didn't quite get what I would like to see. Okay.
And more from Hassett says he is honored to be on the list of candidates.
Hassett's probably going to be the next. Is that what they're talking about right now? Fed chair? Probably going to be the next Fed chair. Nikolai, impressive 45% return in 2025. That's from longs and futures. Zero of it was from futures. All of it was long equities. Yeah, I maybe shorted once or twice. It doesn't even make up for 2% of that performance. So all the futures trading, if I show you the percentage gain on my futures trading, it's in the 2,000% this year. And the reason for that is because I wasn't using my personal money. Well, I guess I was in a way, but I used prop firms, and I spent $2,500 over at Tradeify buying the 5 largest accounts, copy trading them, and getting paid out fully. So when I look at percentage gain from $2,500 to the $80,000 in payouts, that's like 2,000% plus. That money's been spent. I no longer have that money. I need to do it again. And I'm working on it right now. So it's Tradeify now. Tradeify will now allow me to try to get sim profits again. I reached the cap, so I no longer get sim profits. But then they started a new thing called the Select account. So I bought 5 of those, and I'm in their challenge process. I bought them like 3 days ago, and I have to pass their challenge. There's a link there if you want to see what that looks like in this pinned comment wherever you're watching. But if I show you what that looks like, I'll show you kind of where I'm at now within that process. Got about 30 minutes for the Fed to come. That's just the interest rate decision, by the way. So we got about an hour before the Fed actually talks. I'm trying out Tradeify again because they're allowing for me to trade again. I've only been doing it for like 3 days. Well, actually, no, today's my, wait a second. This doesn't look right. Let me see here. Let me refresh this. Okay, so this is what it looks like. I just started on Friday of December to pass the test. And this is the current results right now. Here you go. Current results. This is just a evaluation stage. If I pass this, then I can potentially get payouts again. I spent, I think, a little bit less than $500 for 5 accounts. I did the 50K accounts. I didn't go 150 this time. I just went with the smaller 50K accounts, and I'm going to try those out. Okay. And that's where I'm at right now. Giving it another go. Yeah, so all the performance was basically from longs in my United States Investing Championship account. My other, obviously the Tradeify account's not verified by a third party other than, I guess, Tradeify, and then they paid me, so I don't know. And it was like a demo account, so it's not like my real money. Or sorry, it's not. I don't know. Look up if you don't know what a prop firm is, then obviously you have no idea what I'm talking about. But if you look up like a prop firm or click the little link in the pinned comment there, you'll see what it is. Right? You buy an account, you try to pass their test, or you go direct to funding, which is the way that I went because I didn't want to go through a test. Now I have to go through a test because that's the only option for me, apparently.
And more Just getting remarks from Ukrainian President Zelensky, so spoke with US Treasury Secretary Besson and BlackRock CEO Fink as well as Kushner, said group will work on Ukraine recovery
come here.
document.
Yeah, Ramiz, I actually have a video on my YouTube. If you want to see that video, I talk about the tick chart like in detail. I show exactly what I did while I was trading futures. Do I have to pay an activation fee? I think some firms you have to pay activation fees. I actually don't know if I have to on the select account. I don't think I need to. And in the direct to funding, no, I didn't have to pay an activation fee because it was direct to funding. I hope I don't need to pay an activation fee for the select account. I don't think I do. I have to look now. Select. Yeah, there's no activation fee. No activation fee. No, once you're live, you can't go to those accounts anymore, Rooster. So apparently the only account that I can go to now is Select after being live because I hit my max sim payout. But apparently now, if you went live, which I did, the only thing that I can do sim payouts now is the Select account. At least that's what I read. If you have other information on that, you can send me the link from Tradeify, but that's what I read. Do you need to use Tradier? I don't know what Tradier is. Isn't that like a way to transact? I don't use Tradier. I haven't used Tradier. At least I don't think I do. I've been on Trade8. Yeah, let's take a look at Oracle. Tick isn't useful without market net flow. No, they're completely different. Completely different. Tick charts are for, I mean, it depends on what you're looking at. Are you looking at cumulative ticks? Are you looking at extended readings? Because you can have very bearish market net flow and get a very big minus tick reading, and you could fade that, you know? They're two absolutely different things. You can use them and pair them together, but market net flow can help you really more identify trends and trading with a trend. Tick is for like fighting a trend. Now, cumulative tick can be also utilized for potentially going with a trend as well. Or even if like, say, going with a trend, if it's like, say, if you're really bullish and you have positive market net flow, if it's trading up in this area above 600, 800, it's just incredibly bullish. And bullish, that means you just hold your position. It's going up higher. Right? So it just depends on how you use it. And everyone uses things and utilizes things differently. But I don't know. I have so much time behind the tick chart that there's all types of different things that I've witnessed and noticed and you know, can learn and use. And I've spent a lot of time analyzing flow too. And a lot of things, I mean, I spent a lot of time analyzing a lot of this stuff. And what I came to was I have all this wealth of knowledge of all this stuff. And then I started chipping away things that I didn't really care about or that didn't really bring me money. And I left the things that brought me in money consistently. Market net flow, tick chart. I can pull up like advancing declining volume, right? 80, like all kinds of different stuff for like market internals. All that stuff I wiped out because I was like, is it adding more noise or is it actually doing something for me? Like I don't need to confirm 50 different things before taking an execution of 10 ticks. Why am I advertising prop firms all day? I'm not. I've been looking at charts all day. You probably just got here. And I mean, it was legit to me. One of them was. Like I said, turned 2,500 into 80 grand, paid for my entire backyard. Uber, still going sideways here, but it did break the trend. After it broke the trend, kind of going sideways. Still underneath the 2-3 standard deviation move. I blew my Tradeify live account. So yeah, it took me like 5 seconds to blow it. Not really, but yeah. So you go from if you do live, or if you go from sim account payouts where you can make like max like 15K every pay round, which I was doing, then your Tradeify account's like, or your live account is like only 10 to 20 grand, right? And you could only risk a certain amount. And I mean, my other accounts plus the money I just made, it's either you go all balls to the wall and try to make a big thing, or you do it really slow. But it just depends on the individual. I do not want to spend the time and effort on a $20,000 account when I have much larger accounts that I'm dealing with and much more, money that I've already made, if that makes sense. So I'd rather, if they would have allowed me to just do other prop firm, other sim accounts where I can use more leverage and not try to build a small $20,000 trading account that has, by the way, only 80% of my profits I can take out. So the bulk of people that go live within most of these firms after getting massive max payouts typically just blow up. Now, if you want to just find a firm that'll bring you live faster and you don't go through like a sim payout of like 80K, which I did, you can use I would probably say I think the prop desk or the futures desk or something like that is a prop firm that basically is set up in a way where if you pass the test, you basically go live with $2,000 live account. In that case, I would do that and I would go a lot slower, right? So that's how I would look at it. But the prop firm space is kind of like a game. If you can make money, doing this and you can follow the rules, it's like, talk about just a way to massive leverage. So for think of it in terms of like this. So if you have a 100K account, right? And I spent $2,500 at Tradeify in 5 accounts, right? I spent $2,500. So what is that to this 100K? 2.5%. 2.5%. So I risked 2.5% of my account to get massive leverage. It took me 80 days total to get max sim payouts. You add on that 80K or 60K or 70, whatever the max was. Right now you have 170K balance. That's a huge percentage gain
according to Bloomberg, US
from
does
utilizing
seize
this
oil tanker off
type
the
of
coast
leverage
of
from an account.
Venezuela. According to Bloomberg, US does seize oil tanker off the coast
Futures
of
are taxed at a lower
Venezuela.
rate. I believe so, Jim. But there's tax benefits for different products, even like SPX. But for futures, for these prop firms, you're not even trading live market. It's a demo account, so you're like a contractor. You're paying as if you were like a contractor. Yeah, trading gains shorter term trading gains are great, but you just got to pull the money out and utilize the money. All right, we got about 20 minutes here till the Fed comes out. Market net flow, still not the greatest look of market net flow. That can change quick if the Fed comes out and says some stuff, but so far positioning is not the greatest. You have traders reaching out for hedging. You can look at volatility of volatility, right? We looked at VVIX. It's kind of elevated here, not by any means like a level where, the big guys are really paying close attention to, above that 110. 110, 115 range. That's when things get really spicy. But needless to say, we're reaching for protection, and then market net flow is not that great, and we're kind of trading within that 683 to the dark pool print over here. If we slip through this, it opens the door to 681, which was a area of concentration that we notified yesterday on the video. And then we have our daily implied move down here and our upper daily implied move here. So far, we've moved nowhere, right? Really pretty much nowhere all day. Yeah, I'm going to grab something to eat. And then when they're talking, I'm going to have to step, or maybe right before then, I might have to step away also for just a few moments for, I have somebody come in and install something at my house. Hey, what's up, Colby? Yeah, PL. Cool, cool. Lucid. Yeah, maybe I'll give that. I'll take a look. Rigetti. Yeah, we'll take a look at Rigetti. I'm going to go ahead and take a little bit of a break here. I'm going to keep SPX over here on my side with some of these key 1 DTE levels that we notified, and then we're going to have 2-minute chart over here and the opening range for 30 seconds for NQ. I'm going to put the, sorry, not that. I'm going to put market net flow up here too, just so you can keep an eye on it. I'm going to make it smaller. Keep it down here. Actually, that could be bad. I'm going to keep it right here. There we go. So we got NQ, SPX. We got some market net flow right here. I'm going to step away, get some refreshments, take a little bit of a break. We've got 15 minutes till the fun begins. Be right back. I'll turn on a little bit of tunes, just quiet music in the background too. All right.
And in 10 minutes' time, at the top of the hour, we'll be getting the latest Federal Reserve rate decision, accompanying SEPs and the initial statement, with Chair Powell's press conference 30 minutes later. The Federal Reserve is widely expected to cut rates by 25 basis points to 3.5 to 3.75%, with Fed money markets currently pricing in a 91% chance of such an outcome. And this does come despite widening divisions among policymakers. The latest cut would follow October's reduction, although Powell then cautioned that December cut was far from assured and gave an analogy that driving in the fog you could slow down. Given the government shutdown, key data has been delayed and little has been seen since the prior meeting, but next week we will see October and November NFP, the November unemployment rate and the November CPI. Although markets are heavily pricing in a cut, it is a close call, as there's a clear division in the committee, and given this, there is widely held view that there will be a hawkish cut. Looking at the SEPs, there'll be heavy focus on the 2026 year-end median SEP for the FFR, which currently stands at 3.375%, which Bloomberg does expect to be left unchanged, which suggests 50 basis points of further reduction, which includes 25 basis points today. On the vote split, it is almost guaranteed that it will not be a unanimous decision, given that Dove Meyer will vote for a 50 basis point cut, unless he does have to tweak his vote to a 25 basis point reduction to prevent a tied vote. As always, for a more detailed preview, it is available on the News Talk headline feed around 20 minutes ago.
I'm eating dinner, lunch. I'm in my desk. I'm in my desk on the skyrise, okay? I'm eating lunch. Got about 6 minutes. I'll be right back. Have you seen my office? Pretty cool office I set up. All right, I'll be right back. Hey, what's up, Jalen?
And just on the rescheduled data footing, US Commerce Department says it will release an updated estimate of US Q3 GDP on January 22nd.
Okay. I have heartburn. I ate so fast. Okay, I'm back. Beef stroganoff. My wife made some. I've been calling her mom lately in front of Asher, or my son. No soup for you. All right. Where are we trading right now as we head into it? We got about 4 minutes to the Fed interest rate decision, 30 minutes before the press conference. And in about 20 minutes, apparently, the installers are going to be showing up at my house, so I'll have to step away and navigate them. But I'll have him talking live, and then I'll come back as fast as I can to see if we can get any setups here on the market. Trading right now at 682.39. Market's coming off a little bit here as we're heading into this decision. Whatever. Whatever. First time at a live stream. Cool, Divide. Welcome in. Watch the Daily Show, but never made a live. Awesome. Television. They're installing a TV. Fortunately, I cannot do it. I mean, I could try, but it wouldn't be pretty. It's kind of big. They got to pull off one and then add or put this new one up and install it. It's kind of big. I don't even actually really know too much about the TV. I have no idea. I have to actually look to see if it's OLED or not. I really don't know.
And a minute and a half now until the top of the hour. We're expecting the latest Federal Reserve rate decision, whereby the committee is widely expected to cut rates by 25 basis points to 3.5 to 3.75%. Just for sake of clarity, we will intend to lead with the rate decision, of course. Move to the 2026 FFR SEP, which is expected to be left at 3.375%. Thereafter, move to the vote split, the statement, and the rest of the SEPs.
I don't remember the brand name, Mike. I have to look. But yes, it is. It is. It could be that. It is 100-inch. So I'll see. It's kind of going into our bigger kind of like play space. It's a cathode array tube. What are you guys talking about? I like the blacks in the large TVs, right? The cathode. How do you say that? Cathode, whatever. The CRT, like the CRT monitors. How much percent in my trading portfolio do I enter to fade scalps? Well, if I'm doing like future scalping, like the notional value is pretty crazy on all of that stuff.
10
so
seconds.
I typically do just a couple contracts here, a couple contracts there. Typically start with MNQ and then go from there. But when I fade as far as, here we go, it's coming. Fed interest rate decision.
That's a cut, 25 basis points as expected. Cut 25 basis points as expected. Looking at the median FFR, that is year-end 3.375%, rounds up to 3.4%. That is left unchanged and as expected, which signals one more 25 basis cut next year. Looking at the statement, it does note that the signals rate cut pause by adding extent and timing to describe its approach to additional adjustments to policy rates. And it does note the decision was 9-3, so it's a vote split of 9-3. Myron
9-3,
favoured
wow.
a 50 basis point cut,
Okay.
while Goolsby and Schmidt voted to hold.
Can you take me higher? All right, so we're getting a nice big rocket ship up to that 68.60, where we can potentially hit into a little bit of a congestion up in here. I applied a volume-weighted
just
average
going further
price.
through the statement here, it does note the economy has been expanding at a moderate
If we
pace.
hold
Job
above it,
gains have slowed and unemployment rate has edged up.
first initial move higher.
And the inflation has moved up from earlier in the year and remains somewhat elevated. And does note attentive to risks on both sides of the dual mandate, and judges that downside risks to employment have risen, and it will begin reserve management purchases of T-bills starting on December 12th. And just a bit further, it does note the first reserve management purchase operation round to buy about $40 billion in Treasury bills, and the initial Treasury bill buying to be elevated for a few months.
Okay. Take a look here, see how the
And just
bond
going through
market's
some of the
digesting
rest
this.
of the SEPs now, FFR end 2025 was 3.6%, which is unchanged from the prior and of course in line with the expected. As mentioned, year end for next year 2026 was also left unchanged at 3.375% as expected. 2027 also remained unchanged at 3.1%. 2028 also left unchanged at 3.1%, with the longer run neutral rate also unchanged at 3%. Just making you aware, in wake of the decision, seen immediate upside in US equities and treasuries, downside in the dollar, likely on the vote split there, which was more dovish than expected.
So dovish look. Initial reaction to the upside. Price consolidating after running into that 68.60 level there on SPX. We're currently trading underneath the volume-weighted average price from this announcement. We still have Fed to speak.
Show wide divergence of views for appropriate rate path of rates in
Trading right now
2026
at the
and
opening
beyond.
range.
Just regarding some of the other metrics, Fed policymakers do see unemployment rate at 4.4% at the end of 2026. Once again, that is in line with the September projections, and that is also slightly beneath the Bloomberg expected of 4.5%. Then looking at the inflation point of view, policymakers do see end 2026 PC inflation at 2.4%. That is beneath the prior 2.6% and also shy of Bloomberg expected of 2.6%. And for the core PCE measure, that is seen at 2.5% by the end of next year. Once again, both beneath the expected and prior 2.6%.
All right, so getting a consolidation now. We're just still within opening
And now
range,
on
so that was the
GDP
initial
footing,
reaction.
They do see 2.3% GDP growth in 2026. That's lifted somewhat from the 1.8% in September. They do see the longer run growth at 1.8%. That is unchanged from the prior figures.
Dollar down on the initial reaction, and then the 10-year yield initial reaction was down as well. So we'll see how this plays out. But that was the initial reaction.
Just a bit further within the statement here, it does note the Fed ends operational limit of standing overnight repo operations.
And just take a quick look at oil. And oil is holding up flat for the trading session as it stands right now. I'm interested in this because oil can be a leading indicator. So if oil starts to break through and go higher, it could be giving us some insight into the bond market. Market net flow. Green line we saw shoot up. Red line is coming off, so a little bit more bullish there, obviously, as we saw price action confirm that. We still have a red across the board here on our convergence. And we're getting that chop. As far as SPY goes, we went from that 683. Where did we come to? That 685 level that was identified yesterday's video. We're pushing from that level, and we still have the Fed presser to come in about 25 minutes time. Overall, we're unchanged on the trading session for the most part, up slightly on the S&P 500, and we have a wide range of risk that is still open to come. If I go into the SPY and we look at the trade tab and we take a look at where the market is in terms of volatility for the close of today, still looking at $4.11 of expected move. So the market still has risk in this system. Once Fed is done talking, that'll probably obviously come in. But right now, we have still $4 of movement that is being priced in by this market. Okay. In terms of one standard deviation risk goes. Okay. We kind of consolidated, we pulled back, and we're trying to get back above the VWAP from the Fed interest rate decision right here. So if you're long it, ideal stops would be underneath this opening range, and you'd be targeting up in these areas.
So just recapping the latest Federal Reserve rate decision we just have, they did cut rates by 25 basis points to 3.5 and 3.75% as expected. The vote split, however, that was more dovish than expected, with a 9-3 vote, with Uber, Dove, Myron unsurprisingly voting for a 50 basis point reduction. Meanwhile, Goolsby and Schmidt were the only ones to vote for leaving rates unchanged. In terms of that statement, and as mentioned earlier, it did add the words, the extent and timing of additional adjustments looking forward. And in terms of the SEPs, the year-end 2026 SEP was left unchanged to the September one, which indicates just 25 more basis points of reductions next year. Regarding the unemployment rate, for this year that was left unchanged at 4.5%, but for 2026 it was 4.4%, also left unchanged, but was reduced for 2027 to 4.2%, beneath the expected 4.4 and prior 4.3.
So if you took that trade here, you can probably bring your stop to the break even. Maybe put it in the money a little bit as we're coming very close to that. If you took that quick scalp, you can move your stop up or take partial profits as we just hit that target area. Okay, we just hit a 950 reading on our tick chart. Actually just over 1,000, so we can come and consolidate a little bit here. So not a bad area to take partial profits.
And just looking a bit further through the dot plot composition now, just in terms of where we stand, do note that 6 do currently see the year-end 2025
still got a lot of space left in this market, a lot of risk.
3.875%, which would indicate that 6 voters wanted to hold at this meeting. Of course, did get the 2 that voted to hold in Goolsby and Schmid, but it does suggest we had 4 non-voters.
Okay, my installers are here, so I'm going to step away while this price action goes. I'm going to bring up market net flow once again. I'll be right back, okay, for the Fed press conference. All right, give me a second.
And just once again delving into these SEPs in slightly deeper level. Won't go over it on the squawks, it would be very noisy and pretty hard to understand by me saying it, but just making you aware the 2026 split, that is very divided with no real clear consensus. We have put it on the headline feed, but just making you aware for 2026 and ahead, it is quite divided in the amount of cuts or holds that people do see. And just one to be aware of for big tech names: Meta, Apple, Microsoft, Google, OpenAI, among 13 companies that received a warning letter. Just a bit further on this story, it does note bipartisan attorney generals warn delusional AI chatbot outputs may violate state laws. Just more context, that last headline.
All right, I'm back. Oh my gosh. Okay. All right, we got Fed now coming in about 10 minutes for the press conference. We'll take a look here at the markets. So that's annoying. I got that, the bigger TV that needs to be installed, and they get here and they're like, oh yeah, we can't install that one. I'm like, what do you mean you can't install it? No, it's too heavy. I'm like, what? It's too heavy. I was like, why'd you come down here then? They're like, just to basically, not tell you like, from an email or on phone. I'm like, okay. I was like, but didn't you see what TV it was in the work order? They're like, yeah, no, we saw it, but it requires more people. So you drive way out from the city over to me. That's crazy. So they can't install it. And they said they'll just call me later if they have more people to come by to install it. Which I feel like they're not going to call me by the sounds of it, and I'll probably have to figure it out myself. A 1,000-inch TV, is that what I said? No, I said 100-inch. Did I say 1,000-inch? 1,000-inch TV. They can't install a 1,000-inch TV, dude. What are you, crazy? I can pick this up myself. They're like, yeah, it's pretty heavy. It's 160 pounds. I was like, that's heavy? I was like, do you need me to lift it up? No, but you got to lift it up high. I'm like, okay. Like, I can do it. I can help. Oh, yeah, but you paid us to do it. Yeah, exactly, but you're not doing it. So I'd rather just help and get it done. Well, whatever, guys. Like, whatever. Holy moly. Like, bro, it's hella thin TV. It's like 3 people can lift 160 pounds. 1 person can lift it. It's an awkward shape, so two people can throw that thing over their heads, piece of cake. This was a specialist. This isn't like Best Buy coming to my house. This is actually this is actually a specialist. They do this type of stuff. That's funny, huh? Yeah, this ain't a big box, whatever. These are specialists. Took my creatine. Gotta take creatine. Creatine's good for the brain. Okay. All right, so we left off on that little trade over here. So maybe some of you caught that. If so, awesome. Basically, in short, what did we do? We VWAP'd to the Fed announcement, right? You let it digest. Price came up to some of these key levels, including the 68.60 on SPX, and also that 685 kind of bigger level that we noticed on yesterday's market brief. All right, and then it came in, and then we started getting back above it. This offers up an opportunity to play a pop through. Came into this area, so little risk, more reward. If you caught it, awesome. If you didn't, whatever, there's going to be other opportunities. Now we have the Fed presser in about 7 minutes.
And just on
time.
the tariff footing, EU officials do note discussions between US and EU over tougher sanctions on Russia are ongoing.
Yeah, we'll take a look at the 10-year yield. The initial reaction was, to the downside. We'll keep an eye there. But then also I was kind of watching oil too, because oil kind of broke higher a little bit, so which could be an indication that rates are actually going to just go higher, but you always want confirmation. So the initial reaction down, and then we see a little bit of a bounce back. Still down on the trading session after obviously a pretty strong move higher in recent trade. See if the dollar is doing anything. Dollar is still in and around lows of the session, but yet we're seeing a little bit of a bounce right now. And I could put a little bit of pressure on the markets with the dollar bounce and the yield bounce. If I zoom out, on the minute chart on NQ, where are we? We're basically right back at that 30-second opening range. Still trading above it, but overall, we're exactly where the market opened up as the market waits the Fed. Pull up SPY. We're going to take a look here real quick.
In just over 5 minutes' time, we're looking out for Fed Chair Powell's post-meeting press conference. We have put a link on the headline feed, so I would point you towards that if you'd like to watch it yourself. But of course, as always, we'll bring you all the important comments over the squawk.
$3.71 of expectation still, so came out a little bit of risk. Market's kind of just doodling in around these areas right now. Market net flow. The green line has been picking up. That's positive. The red line kind of came in a little bit here. Still no divergence and still no convergence, and still a bearish divergence. Yeah, Akash, the news feed that I'm using is within Thinkorswim platform. It's free. Are there any words we're supposed to drink to when the Fed starts talking? Sheesh. We got 4 minutes till the Fed starts talking. We're going to go through the Fed website. Volume a bit here. I wonder if I can just go like this and see it on all my screens. Oh, yay. What strategy do I use and do I teach it? Yeah, I mean, I share with how I do it. Strategies change and adapt to market conditions. So it's not just like, hey, I do this setup. Mads Larson. there's multiple strategies, but it all depends on market conditions. And if you subscribe to this channel, the YouTube, and you watch my market briefs, I talk about market conditions all the time and how it changes what strategy you should be using, because one strategy does not work great in all market environments. You have to adapt and adjust. And I talk about that on my videos and my market briefs. Yeah, I teach it, but I don't have like a course or anything like that. All right. In Q, we are at the cash open underneath the volume weighted average price. Wonderful. Absolutely nailed the healthcare call. That was great. Probably don't actually even need this much exposure right now in healthcare. I'm gonna just trim it up a little bit more. I trimmed a little bit earlier today, but I'm gonna trim a little bit more. Got about 2 minutes till we see Jerome. Yeah, I'll trim that. Take a little gander here at Uber because this was one that we were really focused in on earlier. This one came into its 3 standard deviation move. It hasn't really bounced at all, but it's underneath its 3 standard deviation move right now. Broke this trend. We came up into it. Not a bad little short-term trade if you were looking to trade that. And you might still be in it if that's the case. It was a pretty frothy move to the downside, but just know that Jerome Powell's up. And I'm going to mute my news squawk feed. Nikolai, yeah, I draw all my stuff manually. All these levels here, I put in the mornings. Yeah, I do that. Now we know what he's going to say when he gets here, right? We've already got the script and everything. It ultimately comes down to questions and how he responds to various questions. Once again, the initial reaction was quite bullish, so we'll see if he comes in with that more dovish tone or hawkish tone. Let the market digest, let it do its thing. Here we go. Make sure it's loud enough.
Good afternoon.
Turn it up.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although important federal government data for the past couple of months have yet to be released, available public and private sector data suggests that the outlook for employment and inflation has not changed as much since our meeting in October. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals.
A lot of pretty extreme tick readings, very bullish reaction to the market.
The effects of tariffs on inflation will be
nice and
relatively
frothy up here,
short-lived,
so probably
effectively a one-time
nearing
shift
consolidations.
in the price level.
Daily expected move is slightly more above us.
A one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a quarter percentage point. With today's decision, we have lowered our policy rate 3/4 of a percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median
Obviously,
participant
if you're
projects
trading
that the appropriate
NQ or
level of the
futures,
federal
you might
funds
need
rate will be
to back off a little bit.
3.4% at the end of 2026
Again, some
and
really large range
3.1%
candles.
at the end of 2027,
You're going to get torn to
unchanged
smithereens if
from
you're on the wrong
September.
side.
As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement, or repo operations, are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and
Microsoft's
stable
still down
prices.
about 3%, no
We
reaction.
remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation
Google holding
expectations
strong.
well
Looks
anchored.
like it's about to break to new highs.
Our success in
What a
delivering
day.
on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the
Apple in the
country.
same boat.
Everything we do is in service to our public mission.
Healthcare up
At the Fed,
back
we
to
will do
its
everything we
monthly
can
implied
to
move, up
achieve our
1.3,
maximum
4%
employment
on
and
the
price
trading
stability
session.
goals. Thank you, and I look forward to your questions.
Howard.
And I'm trimming some more of my healthcare position.
Thank you. Howard Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral
Cut
value,
that.
and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP
Rates were
growth
cut 25 basis
coupled
points.
with
I'm talking
easing
about cutting
inflation
my
and a
healthcare
fairly
position.
steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some
Back to the
sense
opening
of
range.
improving productivity out there? What's driving that?
So a number of things are driving what's happening in
getting
the
extended
forecast.
readings to
And
the
I would say
downside now.
If you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it is, it's partly that consumer spending has held up. It's been resilient, and
Looking for a bigger-
to
bigger
another
move here
degree,
underneath
it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 2/10
The ring is
out
an
of
alert. Can't change it
2026
right now.
and put it in
not my phone.
2025. So it would really be 1.9 and 2.1.
It's a very important alert, too.
But overall, yes.
Made me
you know,
$80,000 in 80 days. That
For a
little
few reasons,
annoying
fiscal
ring.
policy is going to be supportive.
That one right there.
And as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
Steve.
Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here, and have you taken out sufficient insurance,
That
I
ring that
guess,
you guys want me to cut or
against
lower?
potential weakness in terms of the data we might get
Mark
next
this
week
little
when it comes to
bottom for this
employment?
bounce. Just
So
you
we're
know.
going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have.
That ring that came up
if
here.
you go back,
Also mark
we held
this
our
as
policy
high,
rate at
and then it came in.
5.4% for more than a year because inflation was high, very high,
It's
and
gonna remain up there.
unemployment and the labor market was
If you
really
don't like
solid
it,
at
get
that
off the
point.
stream.
So what happened is over last summer of 24, inflation came down and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, you know, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of big increase in the growth numbers, but not a big decline in the unemployment numbers.
My
And
speaking volume is low
is
because
that
I'm
an
whispering.
AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start
Settings
thinking
and
of it as
stuff have to be figured out
2% per
now in
year,
prime time.
you can sustain higher growth without more job creation.
Get ready for
Of
another
course,
ring.
higher productivity is also what enables incomes to rise over long periods of time, so it's basically a good thing. But that's certainly the implication.
Colby.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the 2 official dissents against a cut, but there were also soft dissents from 4
draw
others.
manually, Andrew.
And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our 2 goals are a bit in tension, right? So interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you, ultimately where do you think the bigger risk is, and it's very unusual to have persistent tension between the two parts of the mandate. And when you do, this is what you see. And I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views. And we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these
T-Mobile
measures,
going into
both
2 standard deviation
inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey, we're going to look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. You talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions, and you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I could make that case. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read. But in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick.
Yeah, T-Mobile's making a lot of communications happen.
Nick Timmerosa, The Wall Street Journal.
Timmy's on.
Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did 2 discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3, is not a big data set. But you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors
also
still appear to be feeling restrictive policy from the
I'm not really executing much into this. I
150
executed a
basis
little bit
points in
earlier.
cuts prior
This
to
will trade
today.
out here.
So I think the idea is that with now having
Main
cut
trade today was
5 basis points more now, and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative,
Market's still doing good.
and we feel like
We have a
we feel like we
crossover here.
have
The green
made
line's been going
progress
straight up,
this year
pretty
in
bullish there.
non-tariff
Don't have
related
convergence yet,
inflation.
but red line's been
And
flat.
as
That's a
tariffs
decent
come
sign.
through, as they flow
So if
through,
we keep going, you look
that'll
up
show
to this
through
upper
next
daily
year.
implied move.
But as I said, we're well placed to wait and see how that turns
And if
out.
we get
That
really
is our
bullish, maybe even
expectation,
try
but,
that 6,900
we're gonna
again.
start to see the data, and it'll tell us whether we were right or not.
Claire.
It's not on my phone.
Claire Jones, Financial Times.
It's in
A lot
Thinkorswim.
of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market
Here comes the
has,
daily implied move.
continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods. And that goods inflation is
Market
entirely in
inflow still
sectors
continuing to
where
crank
there are
higher.
tariffs. So
Nearing that
does
daily
build
implied
on
move.
the story, and so far it's only a story.
S&P 500 basically tagged it.
That the goods inflation, which is really the source of the excess at this point,
Missed it by a couple points there
more
so
than
far.
half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things, and we say that this was a decision to make. It obviously wasn't unanimous, but overall that was the judgment that we made, and that's the action we took.
And just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what
I'd
really
be careful
happened is this. Balance sheet shrinkage, sometimes called QT,
If you're shorting, just
went
make it
on.
smaller.
We had a framework in place for monitoring it, and nothing
probably get some
happened.
good scalps to the short
overnight
side, but
reverse repo facility
flow is definitely
went down
changing more
pretty
towards
much
the
close to
upside.
zero.
So
And then beginning in
this is-
September,
we could still go
the
to
federal funds
6,900. We
rate
can make it
started
up
to
there.
tick
That's
up
outside of the
within
daily
range,
implied move,
right?
but it's kind of
And
within
it
that
ticked up
range,
almost
within
all
that
the way
realm.
to,
And this was a strong move, so
interest on
probably gets
reserve
faded a little
balances.
bit.
There's nothing wrong with that.
Consolidates,
What that's telling you
but
is that we're actually in reserves,
don't like go
in
too
an ample
heavy.
reserves regime. So, we
If you can't
we
take
knew
the
this was
heat.
going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big?
All right, there's the
answer
daily
to
expected
that
move
is,
tag.
if you look
SPY is
ahead,
still a little bit off
you'll
of it,
see
but
that
SPX did.
April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20, $25 billion per month. So that's a small part. That's going on. It's also happening in the context of a temporary few-month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Andrew.
All right, we're at daily EM. We tagged it with SPY 2 after a strong move, so potentially see just a little consolidation.
FOMC press conference.
Flow is still very, very bullish. So once again, if you're trying to short, you could do it, but just be a little bit more aggressive. It's a whole different ballgame when you short, especially strong moves, especially on Fed day.
It's not something
Don't
I
wanna
want to address
lose a
here,
bunch of
Andrew.
stuff.
We're not legal commentators. It's before the courts, and we think we don't think that we help matters by trying to engage as a public discussion of that. I'll give you a mulligan.
6,900 would be a potential IRA to lock in with further upside.
Just one.
I guess I wanted to come back to the 1990s question, and like, do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our two goals. And so that's just unique in my time at the Fed, and I think going back a long ways, we haven't had that. In our framework, as you know, says that when that's the case, then we try to take a balanced approach to the two things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really, but it just tells you you've got to. And I think ultimately what it says is when they're broadly
nice move, Uber. Good.
Or equally at risk, you should be kind of neutral, because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say, and that's what we're doing now. It so happened that we've cut 3 times. That we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy
very, very bullish
performs.
move, bullish flow.
Edward.
Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process that we're looking for that to end? And then because of that, is jobs the threat to the economy?
So
there's a strong move into daily EM. We can anchor from this kind of breakout area
and then there's,
and look for kind of pullbacks into and around this range.
It takes some months.
Maybe even where this low started.
From other parts
right
of the
in here.
It may take, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is,
50-ish.
Isn't that just a one-time price increase? So we actually look at it, all of the announcements and
projecting from that daily expected move.
From all
so
that.
Congratulations to those that were
for
patient.
Each one of them, there's a time period, and then it's fully
wanted to fade for a couple points.
If there are no new tariff
Just
announcements,
understand,
and we don't know
flow
that,
is still
but
to the
let's assume
upside.
there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to
very,
predict this
very
with any
bullish
precision.
move in
No
flow.
one is. But call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this. And after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I want to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman. Does that hinder your
Uber's
current
still
job
floating around
right
its
now,
3 standard deviation
or
move, so
change
not
your thinking at
actually
all?
really much going on there.
Like,
T-Mobile floating around its
No
2 standard
apologies.
daily deviation move, and with a pretty clear trend.
Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024. and the
JPM just hit a
curve
2 standard
basically
deviation
has
move to
been
the upside.
steepening. Why do you think that continuing to cut
Nice
now,
reflexive
especially the
bounce
absence
from
of
yesterday's
data,
price action?
is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very that's one part of it is inflation compensation break-evens, and they're at very comfortable levels. They're at levels consistent once you get out past the very short term now. Break-evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation, as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern, inflation?
So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal, and our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money, and we're going to need to have some years where real compensation is higher. It's positive, significantly positive. So nominal wages are higher than inflation, for people to start feeling good about affordability, the affordability issue. And so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages, so that people are earning enough money and feeling economically
6,900, getting there, getting near.
Victoria.
So again, if you're trying to short this, be careful.
Hi,
And if you
Victoria
do,
Gould with Politico.
just be quick and
Just to
aggressive.
Follow up on that.
Right now, the flow
this
is
now the third
incredibly
time
bullish.
That you've cut this year, and inflation is
Green line
around
falling.
3%. So
Sorry,
is
green line
the message
moving
that
up higher,
you're
faster,
sort of
red line
trying to
collapsing.
send with that you're okay with where inflation is
Saw a
for
little bit of a
now,
pullback
as
from
long
this
as people understand
breakout
that at
over
some
here.
point you still want to get back to 2% because inflation is relatively stable where it is.
Everyone should understand, and the surveys show that they do, that we're committed to 2% inflation, and we will deliver 2%.
Ticks holding high too.
But it's a complicated,
Talked about that
unusual,
earlier in the show.
difficult
High tick readings
situation
that hold are
where
pretty
the
darn
labor
bullish.
market is also under pressure, where job creation may actually be negative. Now, supply of workers
Upside,
has also gone way down.
still in
so
around that
the unemployment
6,900.
hasn't
Let's see if
moved that
anything's
much, but,
changed.
it's a labor market that seems to have significant downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work.
6,900 is
So
right here.
that's really
There's not
important to
much
people.
through that.
The story with
So
inflation
6,900.
and,
Anything
we're well
above
aware
that might come
this
right
is
back into
a
6,900,
story at this
potentially just
point,
doing some
is that
consolidation.
if you get away from tariffs, inflation is in the low twos, right? So it's really tariffs.
About 7
and
points
that's
from there.
causing most of the inflation overshoot.
If I was to fade 6,900, I would look for a break above that, and I want a strong move, strong, like right now, go through it.
Likely to be a one-time,
Right now, you look for dips
Our
to
job
go
is to
up
make
to
sure
it.
that it is, and we will do that job. But right now, you've got this
And trade
difficult
small, 'cause
balance,
things can
and
move
the risks
fast.
to both sides. There's no risk-free path.
You can
If
say
if it was just
anything,
inflation
and this
the
thing could
labor
be
market
down
was just
100 points
really
in 30
strong, then
seconds.
rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry about the labor market. Because the labor market, unemployment was very low, if you remember, when inflation was very high. There was a labor shortage, so we could focus entirely on inflation. Now, it's different. We actually have risks to both, and I think we're doing the best we can for people.
Yeah, NVIDIA is still
They
down on
also
the
care
session,
about
and
their jobs.
Microsoft
They do
is
care
too.
about
That's
affordability.
some weight right
And
there.
the
That's
best
a
thing we
little
can do there is to
interesting
just
to
both
me.
support economic activity, but also, make sure that when tariff inflation goes down and disappears, inflation lands around 2%.
Elizabeth.
Thanks so much, Elizabeth Schulze with ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Oh, well, we know, I think I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody. They have a survey. And there's been something of a systematic overcount. And so
Yeah,
we
semiconductors
expected
making new
them to
high is always
correct it
bullish.
twice a year. So the last time they corrected it, we thought the
Coming
correction
into its
would be
daily implied
800,000
move
or
right now.
900,000. I won't get the numbers exactly right. And that was exactly
kind
what
of break
happened.
off their new
we
highs.
think that has persisted.
But
And,
NVIDIA being the
so
laggard
there's
is
a-
the
there's an
interesting
overcount
piece
in
right
the
now.
Payroll job numbers, we
You look
think,
at AMD,
continuing, and it will be corrected.
highs
I
of
don't have
day,
the
but
exact
it's
month in my
lagging.
head right now, but.
It's probably
and that's
AVGO.
just- Again, I think
AVGO
forecasters generally understand that, so.
is really
and we think
moving
it's
this
about
market
60,000 a month, so
for semiconductors,
40,000
moving that
jobs could
industry.
be negative 20, and, that could be wrong by 10 or 20 in either direction, but in any case, but
So my
the thing
thought is if Microsoft can't get out of its own way, and NVIDIA either, if we do come up to 6,900,
labor supply has also come down quite
NVIDIA
sharply.
is the
so,
largest market cap name, and if that goes down,
if you
it could suck us right back into daily implied move.
There's just no growth in workers, and you
So
really
the
don't
flow
need
is
a lot of
bullish,
jobs to have
but
full employment.
remember, things
Some
consolidate and pull
people argue
down, so.
that's what we're looking at. But I think a world where job creation is negative, I just think we need to watch that situation very carefully and be in a position where we're not, pushing down on job creation with our policy.
When we're talking
like right at
about
6,900.
supply,
I think we
have
can
seen
get it.
major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be. But, for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance. And since job creation, job finding rates are extremely low, if there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up. It really haven't much, so it's a little bit curious. But longer term, though, the question is, what are we going to see here? And we don't know, but it's there's
I'm doing great.
It may be that in past technology, really significant technology.
Big break on IWM.
Innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
Enda.
Thank you, Chair. Enda Curran, Bloomberg News. Given the breadth of views on the policy committee, why is there such a division of views between
On the policy what?
On the committee.
Thank you.
Why is there such a division of views between the presidents and the board members?
You know, it's not so stark as that. The views are more varied on in each group as well. There's some of that, but I would say they're also governors and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
Christine.
Thank you, Chair Powell. Christine Romans, NBC News. I wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy, and what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that asset values, housing values, and securities values are high, and they tend to be owned by people more at the
6900 right around the corner.
end of the income and wealth. So as how sustainable it is, I don't know. Most of the consumption does happen by people who have more means.
Strategy
I think
is
the top third
whatever.
accounts for way more than a third of the consumption, for example. So it's a good question how sustainable that is. The best we can do is to have
still holding pretty high levels up here.
price
So
stability
6900 is still in
and a
sight.
strong labor market. And what we saw, for example, what we saw at the end of the very, very long expansion that ended with the outbreak of the pandemic, we saw that it was 10 years and 8 months or something like that.
Positioned to
the longest
take
one in
advantage of
recorded
the
history.
higher.
In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income. So, having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record.
Yeah, so the housing market faces some really significant challenges. And I don't know that a 25 basis point.
They're making up for last year's
decline in the
December
federal funds rate is
Fed
gonna
meeting.
make much of a difference for people. Housing supply is low. Many people have very, very low rate mortgages from the pandemic period, and they kept refinancing and caught the really low. So it's made it expensive for them to move. And we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time, and so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem, and really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address a secular housing shortage, a structural housing shortage.
Thanks. Chris Rugaber, Associated Press. You mentioned on inflation, services inflation being low, goods inflation looking like maybe it'll peak. We had the wages report you mentioned today showing moderating wage growth.
What a move.
Where are the inflation risks? It looks like inflation is cooling, in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk in inflation is pretty clear to see, and that is, we see higher inflation. As I mentioned, most of the inflation over target is from goods, and we estimate, we expect, most of us, that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected. Is that going to happen now? So that's the risk. The risk is either that tariff inflation just turns out to be more and more persistent, maybe because companies who are now holding back from passing through the tariffs will just keep doing that. So you see that. I think the other possibility is less likely, and that is just that the labor market gets tight or the economy gets tight, and you see just traditional inflation. I don't see that as particularly likely. But so I think again all across the committee, people see the picture pretty similarly, but see the risks quite differently. And some people do see the inflation risk, and I wouldn't dismiss that case. I don't dismiss that case, but you've got to make an assessment, and this is the assessment we made.
All right, come on, we're at that 6,900. Just get up
Hi,
there.
Powell,
Get up there, get through it.
So this has come up a couple of
Stronger
times today,
move,
but
not
to be
this
clear,
sideways
do you believe
stuff.
that we're experiencing a positive productivity
Faster,
shock,
faster,
whether
faster.
from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had 5-6 years of 2% productivity.
On our last live,
growth.
we talked about donuts. Somebody brought that up to us.
This is definitely higher, and it
And
was.
the chart looked
it
really
was
good. We're getting a little bit of a
before-
squeeze there.
Before it could be attributed to AI. I think I also
Pretty high
think
short
if you
interest
look at
name, and
what
it's kinda
AI
getting
can
its
do,
little
and if
squeeze
you
through
use
here
it
right
in your
now.
personal life, as I
took a little
imagine many
position
of
in
us
doing
have, you can see the prospects for productivity. I think it makes people who
Pilot
use
position,
it more
2.5%
productive.
position.
It may make other people
might trim it.
have to find other jobs, though. So it could have productivity implications while also having social and labor market implications that we don't have the
Cut it
tools to
down to
deal
about
with.
1.5.
But yes, I think we're definitely seeing higher productivity. I think it's a
Just
little
kinda
quick to
go.
be saying it's generative AI, but I don't know. The pandemic may have induced people to do more automation and do more things with computers to replace people, and that raises productivity, output per hour.
Does that imply a higher neutral rates,
TXG.
and therefore the policy might be a little
This was
easier than
another
it
name.
seems?
This one's still kind of early
all
here.
things equal, yes, but
I do have a
all things
position in
aren't equal. There are
TXG.
many things pushing in
Holding
different
up so
directions
far.
on where
Nice
the
little
neutral rate would
flag.
be. But yes, that argument does come up.
I'm not going to make any changes to that. There's a pilot position there too. Rocket RKT is breaking out of its flag today. For those that are in the Discord, saw that little trade idea.
After today, you only have 3 more meetings at
I
the
took a little bit of
helm
profit
the
already.
Fed. Since becoming Fed chair,
earlier.
you've seen multiple trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
My legacy. My thought is that I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong. That's what I want. And all of my efforts are to get to that place. They have been all along, but ultimately, that's what I'm. And it's I don't have time to think about bigger things. I hope many years ahead to worry about that, but there's enough to do.
Yeah, ultimately, that's what I want Wolf Banter. But if I was going to fade 6,900, I wanted a stronger move.
Plans on whether or not you plan to stay on the Fed.
My
board
swing
of
trades are
governors
enjoying
even
this,
after
but I'd
your
like
term as
to
chair
do a
expires.
scalp,
And
like some more
I'm
scalping.
focused on-
I caught a
I'm
little bit of
focused
the move
on my
here
remaining
earlier.
time as chair. I haven't got anything
And I'm
new
pretty
on
much
that.
done for the day. Here we go. Here's that
For the-
6,900. It's
Mark,
coming.
For the last question.
pull up my
Chairman,
ticks.
Mark Hamrick with Bankrate. Even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates, or yields to be more precise, have peaked, while
I
key
just missed it by a
borrowing
cent
rates
or two.
remain elevated. And that's, as we've discussed here, as many Americans struggle with liquidity or emergency
12 or
savings
something?
challenges. Is
Get
that
out
just
there.
collateral damage or an unintended consequence because your tools are limited in addressing individual or
This
household
isn't getting
liquidity
greedy.
constraints,
Trading a
insufficient
micro is
money
not
in the
gonna be
bank?
greedy.
I don't know. I wouldn't agree that that's collateral damage of
But
our
you're right.
of
Don't
our.
get greedy.
I mean, over time, we do what we do in order to create price stability and maximum employment, and those things are hugely valuable to all the people we serve. When we raise rates to bring inflation down, that does work by slowing the economy, but we've moved back our policy back down to where it's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave, sort of every large economy in the world, sort of every large open economy.
Now, if I was going to fade, I
market-based
want it outside of the
economy
blue
had
line
a
up here.
wave of
I want it
inflation
outside.
looked an awful lot like
Because
ours.
we consolidated a little bit
We
here
actually
on
came
NQ.
through
So
better
ultimately,
than any
I'd want
other
to see
country,
it
substantially better.
break through this
We had
consolidation
higher
in
growth,
sharp
we had better
fashion.
labor market, and this is really due to the American economy. We have an extraordinary economy, and
If I don't get what I want,
people are innovative, they
all
work
good.
hard, and so we're all of us who work in economics jobs.
incredible day
really
in all the
fortunate
portfolios.
to have
So
the
hopefully
US
everyone
economy. So
is having a good
thank you very
trading
much.
session today. And their portfolios are looking nice and healthy as the market's pretty much at new all-time highs. There goes the Fed. All right. Test. 1, 2. Test. 1, 2. All right, there we go. I'm going to go ahead and put back this on. See how the market reacts now. The Fed stepped off. See now the market digests a little bit of all this good stuff. Very bullish market net flow. Look at this crossover over here. Boom, boom. Get convergence. We just ripped. Now the Fed's off.
And just making you aware, Chair Powell...
We're coming back into the
press
daily implied
conference
move. So
hasn't
didn't
now
quite get to that
concluded.
6,900.
Just recapping some of his main
Well, we might
remarks.
still.
Of course, we've covered it extensively, and they are all available on the headline feed, but just going over some of the main ones. Of course, overall, it was a net dovish press conference, as we can see from the reaction across markets, particularly when compared to the tone of the October one. Powell did appear more concerned about the labour market side of the mandate than inflation, and he did stress several times that there are downside risks to employment, while saying it is a reasonable base case that the tariff effects on inflation will be one time. Despite saying that, he was optimistic on growth, noting the baseline outlook would be solid growth next year as fiscal policy would be supportive. When asked about why they cut today after the October decision, he did note there has been a gradual cooling in the labour market. They think there is negative 20,000 payrolls per month, and inflation has come in a touch lower. While speaking on payrolls, he also suggested the overcount is around 60,000 per month, while labour supply has come down sharply. Do note, despite the dovish nature of this press conference, some hawkishness was seen as Powell said they are well positioned to determine adjustments to the policy rates, noting that rates are now in a plausible range of neutral, later describing policy rates as at the high end of neutral.
So we came into that 6,900. Basically, I mean, we're right there. I would have preferred like a move through it, and we still might get it. But the high of today's SPX candle was at the 98.88 handle, and I was looking for the round 6,900 there. So very close, but that's fine. It makes sense to me, quite honestly, that when we're up here, why it would make sense for a little fade back into and around these areas, let the market digest. It's because Microsoft and NVIDIA, dude, are down on the day. Here's NVIDIA, right? It's kind of consolidating here on the minute time frame. Okay, so maybe, if this starts breaking back up to the upside, we go to 6,900 in the SPX. Microsoft is down 2.57%. It's fighting its daily VWAP right now. Perhaps we're trying to break through this right now and start head higher. If that's the case, this is a great combination for the market to pick itself back up after a little bit of a pullback. Okay? Market net flow is still incredibly bullish. So yeah, it still goes to the thing. Yeah, if you're trying to short this, make sure you're doing extremes and then you're getting out, somewhat aggressively. You don't want to just keep averaging into a short and just keeps, ripping your face off. Don't be stupid, right? We can't control, if it reverses, falls flat on its face, and or if it keeps going higher. So the only thing you can control is what you manage as far as your risk goes. Daily implied move, we're kind of just trading in and around this area. Holding above the Fed VWAP, the JWAP, the Jerome weighted average price. Looking for a move through 6,900. One standard deviation. If we look at the 1 DTE options or 0 date, the 6,900 is over here. That'll change if we get closer to it, but there's not much through that area. Maybe 20 points, 20 points up in here. So anything through in this range, we probably come back in a bit, which I would be fine with, right? So for whatever reason, if we just squeeze out to 6,920, I'd be looking for a price to pull back into and around this 6,900. Okay, or maybe even 6,910, you try to small and then comes back in a little bit. But overall, we're right there. So the risk to reward is obviously skewing. So for me, right, I didn't day trade much into this other than just once or twice, right? I can show you those profits, but my swing trades did incredibly well today. So I trim off some of those profits as we're hitting into some of these levels, and then I'll just keep some runners on, and if it wants to keep going, great. New all-time highs in my United States Investing Championship portfolio, new all-time highs in my shorter-term day trading portfolio, new all-time highs in my IRA account. And these are verified, once again, by the United States Investing Championship. If you want to see that, that'll probably be January. At the end of January, you'll see my year-to-date performance. Good stuff. And this was basically from trading the long side of equities. Back-to-back years, 20% plus gains in the S&P 500. This year, the S&P 500 is darn near that. So it's been a wild ride these last 3 years. Obviously, easy times sometimes bring on more difficult times, just like difficult times could bring on good times, but you got to be prepared. Either way you look at it. Akash, so if you're in Thinkorswim trading platform, you go over here to chat rooms, you go over here to global news, click global news, it's going to bring up a live news feed. You go ahead and click listen, it's going to be an audio of a news alerts live stream, okay?
And just further from the Bank of America CEO, Moynihan expects Q4 investment banking fees to be broadly flat, and they don't see indications of consumer financial
It's all over
stress.
within days. I mean, okay, so that means just more opportunity is going to come. Yeah, I don't care if it's going to be over in a couple of days. I don't care if it keeps going up higher. I just trade what's in front of me. I do not care about the narratives in that one day it'll play out. Because I'm fast to react. I know for a fact that I can get out of markets and be heavier into cash in a flick of a wrist, click of a button. You know, it doesn't bug me. It just doesn't bug me. What would bug me is if I hung on to a narrative for a long period of time and I miss everything based off of my thoughts. Trading is about, a disciplined approach, and your biggest advantage is the ability to change and adapt to markets. Your competitive advantage, your edge, is your ability to change and adapt. Oh, you're welcome, Akash. Pass your Tradeify, Val? Hey, heck yeah, dude. Good job.
Do note commentary from US President Trump says that growth.
You've been using it for years, didn't know it existed. There's a lot of interesting stuff on Thinkorswim that I know about. It's kind of hidden features. That's one of them. It's pretty cool. Did you know you can get options flow on Thinkorswim for free? So you don't need to pay option flow services? It's a pretty cool little feature. It's called Trade Flash. Tells you when you get big delta trades, big equity trades, it pops up here automatically, or you can search for a specific symbol like SPY or like Qs. It'll show you what's happening live then, or you can just hit no symbol, boom, and you can get bigger option orders, bigger equity orders right here, right in Trade Flash. There you go. There's some free options flow there. Let me teach you another thing. If you're wondering, hey, you know, is this a lot of options trading on the day? Like say if I go into like Tesla, all right? If I go into Tesla and I'm looking at the statistics down here, how would I know if this is a lot of options comparatively to, you know, history? This right here is called the Sizzle Index. The Sizzle Index is actually showing you a number, and this number represents the amount of options traded versus the last 5 days. So if you get a reading that's like, you know, 2.0 or higher, it's trading, you know, 2 times the amount that you typically get in the last 5 days.
Have 20 to 25%
right now we're at
GDP
0.8.
growth.
And you have call sizzle and put sizzle there too as well. It's the same thing, but just more focused. Yep, MOC data. Yeah, I believe Trade Flash has that too as well. The end of day when it puts it there. Pretty cool stuff. All right. All kinds of cool little stuff. All right, come on. We're going to get that 6,900. It's going there. For my sake, I hope it goes right through it.
Further here from Trump does note if market goes up, we should encourage it to go
Sizzle,
up
sizzle.
more.
Sizzle, sizzle. Shizzle, shizzle, ma dizzle. You blew 3 accounts. Okay, it's fine. At least it was or hopefully they're prop firm accounts. So it's, you know, it is what it is. Those are, you know, whatever. You blow 3 prop firm accounts, you get them back up and running here in a few days' time. At least it's not a, you know, full-blown investment account. Had no idea what sizzle meant. Well, now you do. Another cool feature, you can actually get the book map if you just reach out to support. And I believe that you can get Apple and ES for free. So if you reach out to support and you say, hey, can you put Bookmap on my desktop? You can buy the subscription and it's like $30 a month, whereas that's a lot cheaper than going right through Bookmap itself. And you could see the order book, which basically is this. Hold on. You know, if you go into level 2 data, you click level 2, this is the order book, shows you where orders are hiding out, the amount of orders on the exchanges. But if I minimize this and I go over to Bookmap, I can visually see it in a heat map form.
It did pursue deals that boosted startups.
We're trying to look for the 6909 over here on ES. Got some liquidity up there above us.
And Intel explored bids of startups
Anything's
Rebos,
open below us.
Sampanova, where Tan served as chairman.
Yeah, we got to that 6,900. Tagged it. Fortunately, NQ is just kind of going sideways, so this looks like if it can break out, it's gonna bring this up higher. So I'm not really interested anymore in that, you know, fade of 6,900. I was interested, you know, when it looked like over here like this, but you know, over here, you know, if I look over here at you know, Microsoft, and if this actually starts breaking up higher, and then also Nvidia, right? Nvidia, if this actually does start cracking up higher, which it didn't actually, and we still got there. That's interesting. So floating a little bit off of it, but that's probably where we're going to get pinned in and around. If we can break through it substantially, you know, that'd be kind of nice because I feel more confident of doing some sort of a fade trade. We're right here floating around the daily expectations of the market. And then market net flow is still just, well, actually, it's changing up a little bit here. Very bullish for this move, but then we're kind of seeing it turn a little bit here. I'm going to run to the restroom. I'll be right back. They give 2 free stocks each month. Thanks, Daryl. See, I didn't know that for sure. Thank you. That's kind of cool. I'll be right back. Just going to run to the restroom. I want to keep market net flow up here in the corner. Keep it a little small. Actually, that's too small. I'll go like this. I'll be right back. Nice reaction overall. Once again, I just hope everyone had a good trading session so far. I'll be right back.
And further from Bank of America CEO Moynihan does note they will buy back more stock. Of note for AIG and Chubb CB, according to Insurance Insider, Chubb made informal takeover approach for AIG, but when approached for a comment, Trump denies that it submitted an offer for AIG.
Well, that's annoying that it disconnected there. Okay, I'm back. A lot of nice moves in the market. Weekly implied move for the S&P 500 could bring us up to and around 695. I want to go ahead and show you too over here on my left-hand side. Our weekly implied move is 69.70. And we have still that 7,000, which was that main target that we've been talking about this year. That's the JPM color up there and the call wall, where a lot of focus and concentration has really just been at all day, or all this quarter, and prior quarter too. A lot of focus in on over there. Yeah, we can check silver. Nvidia just coiling up over here. Okay, let's look at silver. New highs. Yeah, this thing is just cranking. So good reaction from the Fed too. This is just continuing to go. Let's take a look at gold. Gold is trying to break from this little consolidation here. Doesn't look bad. Okay, 10-year yield. yeah, it's pulling in a little bit, but not a little bit of a collapse here after the Fed was done talking. The dollar broke lower. Today. So it's still kind of, dollar's actually really following what we've been talking about and how we compared it to the year of 2017 and 2018. Microsoft killing the Qs. Yeah, Microsoft's, it's not, I wouldn't say it's killing it. It's really definitely killing the vibe. Right? It's going to be a drag with Microsoft looking like this. Like the market can still go higher, but having Microsoft and NVIDIA down, it's definitely going to be a drag. Microsoft mainly. NVIDIA, if that was down 2.5% right now, the market would be not looking like this. It'd probably be, if everything was in place where it's at, it'd probably be break even on the day. Probably be down here. It's a drag right now, but it could definitely be a sleeper. So there's pros and cons to it. But we would need the proof, right? So if it starts breaking up to the upside, that would be a great sign. Tesla holding up well. Consumer discretionary doing fine. Take a look at our Amazon friend. Amazon breaking back above this little trend here. Looks pretty good. So we played from down here at last year's closing price in the trend line, bounced up, kind of rejected. Now it's kind of trying to break from this trend, get back above these key averages. Amazon looks pretty good. Amazon looks pretty good. Pretty darn. Hasn't been anywhere all year. Like for the year to date, Amazon is underperforming, right? It's up, 6% from a year to date basis. Apple, nice pullback, and we're seeing a little bit of a bounce here at around the 20-day. Jay Powell said a lot of different stuff. Ultimately, I care what the market does and how it reacts. And so far, it pulled us into some of our key levels, daily implied zone, and then also that 6,900. Last time we were at 6,900, we got a little bit of a rejection. Market net flow, bullish. Okay. We can look at KRE and Jets. I would imagine KRE is doing fine. I would imagine that because I haven't pulled it up, but I would imagine it because IWM is doing good, and IWM has a lot of like regional type banks and stuff, right? And IWM is up there. So let's see how KRE is. Yeah, KRE is doing great. Up 3.56% today. Breaking to a new year-to-date high. I wouldn't necessarily chase it, but if you start to see consolidations in these things, create opportunities. This came, from a low level, fired off. Jets have picked up too, quite a bit, right? This makes sense to me. A lot of in Q4, airlines do typically pretty good. So Jets is kind of breaking up higher. Boeing was shaping up, but this pulled down. So Boeing's not getting
Trump
quite the nice shot as some of these other airliners.
For a very good reason.
We'll go back to Uber. Anybody take the Uber trade when we were talking about it throughout the day? That's back at this 2 standard deviation weekly move. Still underneath the 2 standard daily, but we hit under a 3 standard deviation move. Play back into it, hold some, whatever you do. But Uber was a massive outsized trading session today, and same with Lyft. And then T-Mo just recently, I'm sorry, not T-Mo, T-Mus. T-Mo. I called T-Mobile T-Mo, but T-Mo is actually Thermo Fisher. This one came into its 2 standard deviation move, and now it's kind of just trailing a little bit lower, but it did break this trend. And this one got clobbered these last few trading sessions as it broke to new lows. Contracted, expanded to the downside. Right? If you're trying to buy dips, you look for outsized moves. Horrible looking chart, but we're pulling into some extended territory from a daily perspective as we're breaking down here. So this kind of stuff creates little opportunities here and there. Oh, good stuff. SMX. Yeah, I don't know. These things are all like hype stocks probably. What is this? What is this? SMX. What am I looking at here? Yeah, it's too illiquid for me. It's like all over the place. Like we're talking a couple hundred, like volume is like nothing from an intraday base. I can move this stock. I don't really trade that kind of stuff. It's not my style. Netflix. Yeah, Netflix breaking down pretty hard. Netflix is that the weekly implied move? It's well outside of the weekly implied move. Netflix is getting just absolutely hammered. Kind of like it, actually. Let me see here. So, I mean, it makes sense, right? We broke down, so you don't want to, like, if you're day trading it, I can see that, but swing trading it becomes a little bit more difficult. I think we talked about that on our last live stream. Today, let's pull up some stuff here. I believe that I have it already preset, but I might not. So let me go side by side. Yeah, so Netflix is well outside of its weekly expected move. RSI's in that oversold condition, and that's a pretty frothy direct move. Right, very frothy direct move. Let me see if in terms of 2 standard deviation move. There's been a lot of news back and forth with Netflix and Warner Brothers and all that stuff. Let me just pull it up really quick. Netflix. Yeah, 92.61 is the 2 standard deviation move. So we're right there. I mean, I'll take a position in Netflix just for a shorter term bounce if we can get to 92.61. Sure. This has been destroyed these last few sessions. I wouldn't care if it goes against me more. I would just start small. Maybe not for an intraday bounce because it's only 10 minutes left, obviously. But right in this area, if you just a little position, and maybe even tomorrow, if we get a continued 2 standard deviation move. All right, these big frothy moves to the downside can create some shorter term opportunities for scalping, for fading. But remember, when you're fighting trend, you don't go heavy. You can't really go heavy when you fight trend. If you go heavy when you fight trend and you're wrong, it could be damaging. You need to be well capitalized so it doesn't hurt you. But yeah, right down in this area, it's a pretty big beastie move right there, down 3.86%. Flushing a lot of people out. Look at this, from all the way up here down to here. So, maybe a move back up to weekly implied move, or maybe even just half of this candle. I mean, that right there alone from where we are now just is, about 1 to 2%. That's great. I'm not trying to catch a bottom for like this, to make new all-time highs in names like this, but yeah, it didn't show up on my alerts today because there was no 2 standard deviation move. But nonetheless, not a horrible setup. T-Mobile. Still doing its thing right around 2 standard deviations.
I just heard here from Trump on Ukraine said they would like to go.
I did not find it with a Bollinger Band alert. No, I don't do any Bollinger Band alerts. Is there a schedule for my lives? No, there's no schedule at this moment.
Determination based on what Ukraine come back with.
just heard some Ukraine talk. Oh man, oil today, a little interesting to me. Seeing oil come back up, especially if it starts heading higher. Then I think that this whole TNX CGI, I feel like this is just a regular pullback.
Market imbalance. That's roughly 1 billion to sell. 1 billion to sell.
There's your trade flash. Here we go. We're getting that little flush there with Netflix. Let's see if it comes down to 2 standard deviations.
And further from
Here
Trump on Ukraine.
Yee!
Does note, meeting with Zelensky in US is what is being requested.
See if it gets there. Come on. Get there. Get there. There, got there. There you go. So if you're patient, 92.61, that's a 2 standard deviation daily move. Obviously, this, you day trade this with 9 minutes is kind of crazy work. But, if I did like a pilot position of 1% and I'm playing for a bounce, that gives me room to navigate around the position on more downside. You close at the lows of the day, you typically get follow through, right? You typically get follow through to the downside. So you got to be prepared for that. It's not always the case. So, if it bounces up, you got to sell into it and you're like, oh, I could have bought more. But the times that it continues to the downside, right? And you have a small position, you're like, whatever, I don't care. Sort of thing, I don't necessarily know if it becomes like a generational buying opportunity or anything like that, but these outsized moves create shorter term opportunities, but you can't, and you'll realize this with time because chances are you'll hear what I'm saying, but you won't, take into account what I'm saying. But if you go too big on a move that closes at the lows on a 2 standard deviation move and you get continued follow through and your position size is too big, it's going to wreck you, right? It's going to wreck you. But if you approach it in a way where you're well capitalized and you have like a 1% position because you're fighting trend, right? Or 2%, whatever your situation is, and then you're playing for a little bit of a bounce, it gives you room and breathing room to kind of trade, right? In fact, in that case, you're happy if it goes lower, right? You're like, oh, it's going lower, great. I can try to build this into like a regular bounce position. But yeah, you typically wait for these real outsized moves. So today we just hit a 2 standard deviation move, and sure enough, guess what? Asher alert came right into my Discord right when it happened. I'll show you. Right here. Bam. Came in, tells you the time, gives the alert, tells you the level. So if you're in the Discord, you got that alert. If you're not in the Discord, you're obviously not going to get these alerts. But we had Netflix just hit it, and then we had 3 other names just hit their upper standard 2 standard deviation move. Shopify, right? We had Shopify just hit the upper. We had MT, whatever. What is MT? And I'm familiar with this one. And then DHR, which is that housing? No, I can't remember what this one either. This one's more familiar to me though. What is this one? Healthcare, that's one.
Potential vote for Warner Bros. Discovery, WBD. Trump says, I think CNN should be sold.
Cool. You're on Discord and YouTube? Nice. What's your biggest loss so far this year? My biggest loss this year? I think it was around the, it wasn't one name. It was when all the tariff stuff came into play. That was like, it was a fast. So, okay. So I'll pull up my chart. I'll pull it up. So here's SPY on the daily time frame. So in March. Yeah. So basically right in around this area, somewhere around here, that's when my portfolio took a quick dive because I was preparing for a pretty substantial bounce.
We do have a couple of earnings.
I'll show you what it looked like.
Namely, Oracle and Adobe. They are both due at 5 minutes past the hour. For Oracle, EPS expected of 163 and revenue of 16.18 billion. And Adobe, EPS expected of 538 and revenue of 6.1 billion.
I can't quite recall. It wasn't like one name. It was my portfolio itself, right? It took a hit, but it was like literally a day or two. And during that time, I was preparing for a bounce. I was prepping for the bounce. So it was a fast move. Now, I don't want to do that again. I felt quite confident, but then also after coming out of it, I was like, yeah, that was too much. I went a little bit too much. So here, that's what it looked like. This. So slow drag down, nothing crazy. And then when I started getting aggressive for the bounce, because I wanted a fast bounce, this was, that was in March. So my low was in March 10th. So S&P 500, so March 10th was right here. So this was my low in my portfolio, was right here. So it went down and down, down, and I was building into a position, getting ready for all of this. So my low was March 10th, and then from that point, I, rocketed higher. And then from that point, right, it's just slow grind up, taking little, hiccups, slow grind up, consolidations, breaking to new all-time highs. So that's what my portfolio looks like. S&P 500 coming back into its implied move. Resting a little bit here. Got about 3 minutes left. Netflix still breaking down lower. How do I pull up my, there we go. And S&P 500 is legitimately sitting on its daily implied move right now. Okay, coming into the market close. Good trading day. Do I use ATR? I don't really use the ATR, but I'll look at the range of the candles through eyesight. Right. Sometimes I'll put it on there if I need specifics, but no. A lot of what I do is just visual, looking at the candlesticks and then seeing how it's setting up. Is Oracle reporting earnings? Is that why people are bringing up Oracle? Is that what's going on right now? Yeah, so Oracle, what, after the bell? Okay, I'll give you some insight into Oracle.
Today, Trump says he's meeting with Kevin Walsh today. Not got any further context to this, but just making you aware, Trump does say he's meeting with Walsh today. And just in terms of context, that of course we are still awaiting the new Fed president that Trump will pick after Powell, and Hassett is the big favorite, but just making you aware of that comment from Trump.
This is the expectations for Oracle. Beat or not, we don't know which way it's going to go. But this is, we know, is one standard deviation of risk for Oracle.
On the Fed, he does note rates should be the lowest in the world.
To get to Discord, so if you sign up for the Discord, you obviously are signing up through Patreon, right? So the first step is to sync your Discord account to Patreon. And once you do that, you're going to be given a role automatically through the Patreon bot. And then you could go into the Discord and then you could just watch the Getting Started post. I've added a lot since then. And then just kind of look around. Don't be in a rush to do anything. It's not like it's a super expensive server. $16 for a month, right? So don't rush to anything and just look at all the different tools. There's so many different tools and so many things that I offer in there. Okay? Look at them. I have history dating way back with all the old trade ideas. You can go see how did it play out? Where would I manage risk if it went against me? Where would I have played my stops if it went in my favor? Right? You can look at the old expected moves in there. You got the Asher bot, which you can pull your own expected moves. You get alerts. You get the Trading Ticks query, which offers you all types of cool stuff there. It's insane. Okay. All right. So S&P 500, we just closed right there at that expected move, slightly under it. S&P 500 finished right on the, look at the expected move. Let me zoom in here. Look at this thing. This level we knew yesterday. So we closed at 688.679. The expected move was 688.703. Crazy. Came into that 6,900. Would have made a good short there at 6,900, but I didn't like how it's set up on the NASDAQ, so I didn't take it. Story of my life. It happens all the time. But I don't care. I love it. I love it when that happens. I love missing out on trades. All right, y'all. I think I'm going to call it there. I'm going to call it there. Netflix. Going to be interesting. Let's follow up on Netflix, see how it plays. So we've closed at the 2 standard deviation move. All right, close right on it. Well, actually, I'm going to extend it to the left, extend it to the right. I'm going to make it pink. And we'll see, like, if you bought a little bit here and see what it does and, go from there. Closed at the low, so I'd imagine we get some sort of follow through, but we'll see. We'll see. Auf Wiedersehen. See you, everybody. All right, Fortitude, Colby. Appreciate y'all stopping by. Mahalo, Barkster. That's cool to know, man is. Yeah. If you could have built that mindset, I love missing out on trades. Yeah, build that mindset. Just work on it. If you love missing out on trades, it's not too late. Thanks, Janir. Thanks, man. All right, Ethos. See you later. See you, Zulf. See you, Eco Signals. Happy holidays. Merry Christmas. Happy New Year. I'll be back before all of that. See you, Exotic. Always good to see you in here. Java.
And just making we are expecting
all right, everybody. Thanks for
Oracle
tuning
and
in.
Adobe earnings in around 2 minutes' time. If both hit at the same time, we will lead with Oracle numbers.
See you, Wolf Banter. All right, I'm out. Goodbye.